1, 2, 3. We were rolling, rolling, yeah. Rolling on the river. One, two, three, four. Good morning, people. When I started out nice and easy. Now up. When I left a good job in the city, working for a man every night and day. But I never lost one really to see. Worry about the way things might have been. Big wheels keep on turning. Proud Mary keep on burning. We rolling, rolling, rolling on the river. Rolling, rolling, rolling on the river. Town in Memphis, until I tamed in Tennessee. But I never saw the good side of the city till I hit a rock on the riverboat swing. Big wheels keep on turning, strawberry keep on burning, and we rolling, rolling, rolling on the river. And we rolling, rolling, rolling on the river. Down to the river, you're gonna find some people who live. You don't have to worry if you got no money. People on the river are happy to give. Big wheels keep on turning, Mary keep on burning, and we rolling, rolling, rolling on the river. And we rolling, rolling, rolling on the river. And we rolling, rolling, rolling on the river. And we're rolling, rolling, yeah, rolling on the river. Toot, 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 toot. Hey, come on, come on. Hey, yeah. And I said we're rolling, rolling, rolling on the river. And we're rolling, rolling, rolling on the river. Rolling, rolling, and we're rolling on the river. And we're rolling, rolling, rolling on the river. Thank you.
Ladies and gentlemen, thank you so much for joining us this morning for our Investival 2022 webinar. We hosted our in-person event last week and had a really good day. It was good to see so many friendly faces, but we understand that not everyone can make the trip to spend the day with us, so we're making sure you have the opportunity to see the same calibre of talks from our amazing lineup, albeit condensed into 15-minute presentations. I'm absolutely delighted to be back with you and be your host this morning, introducing each of our speakers. Now, just a little housekeeping for you today. If you'd like to ask questions, you can do this in one of two ways. Either using the chat function in your control panel as we go. The questions will find their way to the speakers and we'll get replies back to you as soon as we can. Or you can request contact from any of our presenters when the automatic questionnaire pops up at the end of the session. Please be sure to complete this feedback form and we'll ensure that your CPD is supplied with a copy of the slides in the next day or two. So all that remains for me to do now is to announce our first speaker. This chap is an Investival veteran and a man whose impressive bookshelf has featured on more TV broadcasts than most of us have had hot dinners. Well, we are in an energy price crunch. Talking us through the potential outlook for economies, markets and portfolios, our investment director and reader of the tea leaves, ladies and gentlemen, Russ Mould.
Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the 2022 Investival. I'm going to talk today about a piece of the action and how you can get it, or at least keep it, for yourselves and your clients. Now, there's a speakeasy theme to the event this year, and this is the best I can do as a bit of a spod. Series 2, Episode 17 of Star Trek, with Leonard Nimoy and Bill Shatner as Spock and Kirk. For some bizarre reason, they end up on a planet that's been inspired by 1920s Chicago. Now, you'll be thrilled to know that's the end of the science fiction references, but do keep the theme in mind, a piece of the action, as we're returning to that later. So what are the key topics that we're going to be touching on here? Well, here they are. Central banks and why they still matter, and I'm afraid to say they do, particularly because of their influence over the price of money, the implications of that for central bank policy going forwards and asset prices, and then some key lead indicators for you to watch to try and decipher what may be coming from markets further down the road. Now, this is one of my favourite pictures of all time. It's Richard Burton and Elizabeth Taylor. This is Taylor's 40th birthday party in Budapest, yes, in 1972. Yes, they were so wealthy they were able to go behind the Iron Curtain and still organise a massive knees-up with the blessing of the authorities. Now, the moral of the tale here is, within 2 years' time they were divorced. They tried again in 1975. The second marriage lasted barely 6 months, and hence Charles Louis Gave's rather acerbic comment on the other side of the slide, believing in central bank omnipotence is like second marriages, a triumph of hope over experience. And this is where we are right now in financial market terms, because central banks have already made a mess of their inflation is transitory tale. They're now wanting us to believe that after 14 years of monetary policy experimentation, they can not only control inflation, but engineer a soft landing for the economy at the same time. Believe what you will. Now, they do have a difficult balancing act. Of that, there is no doubt. You could argue I'm being unkind. They do have to juggle inflation and the damage that does to consumers' pockets on one hand, recession, the damage it does to jobs, and therefore really does to their pockets on the other. They're also looking at financial markets, financial instability, particularly after the LDI carnage in the UK in October, and also currencies. The dollar is very strong, multi-year highs. The pound recently has been at multi-decade lows, flat on its back. That has implications for local economies and therefore local central bank policy as well. Equally, you can say these are issues that central banks have brought upon themselves. 14 years of quantitative easing, cheap money. Zero interest rate policies, cheap money. Funding of mad government deficits, kicking cans down the road. They've all brought these problems, to a head, you could argue, or they're coming to a head now once they try and start to withdraw that stimulus. The chances, again, of them withdrawing this stimulus after 14 years without something somewhere getting a bit choppy, to me, seems pretty limited. Now, we can already see some of the consequences. We can see inflation in the top left, have this slide here. Very familiar with it. Maybe, just maybe, showing a peak in the US, and that's something, a fact for which financial markets have been reaching for succour and comfort, and we'll come back to that. And then in the bottom right-hand corner, two of my favourite indicators for both the economy and stock markets, small caps and transport stocks. They've both been looking really pretty ill for the last 12 to 18 months in anticipation of a recession, in anticipation of tighter central bank monetary policy, and you can understand looking at that why financial markets are starting to pray for a pause, or at least and then a pivot in central bank policy, a slowing of rate rises, a halt to rate rises, and then rate cuts. And again, this is what we've had this year. Over 300 central bank rate increases around the world. That's more than in the previous 5 years combined. We've had about a dozen cuts. And generally speaking, they're from either the extremely unorthodox, Turkey, a pariah, Russia, or a country with its own fairly substantial economic challenges in the form of debt and a housing bubble, China. That's not a good company to keep, at least economically speaking. But again, financial markets are feeling the squeeze of these rate rises, and they're wondering when they're going to get a chance to start breathing again. And again, we can see here quantitative easing. This is the combined aggregate central bank in trillions of dollars of central bank balance sheets in Europe, Switzerland, Japan, the UK, and America. And as you can see, their balance sheets are basically quintupled in size since 2008. How on earth are they then going to sell all of these assets seamlessly without there being a problem somewhere is something I find extremely intriguing. Their balance sheets are just starting to shrink now. We're already seeing equity markets fall, bond markets go into a tailspin, cryptocurrencies, ape JPEGs and other things being taken out to the woodshed, just after in the end only a very minor retreat in central bank policies, let alone what they're promising, which is further decreases down the road. Why does this all matter? Ultimately, it matters because bond yields are going up, and this is the 10-year Treasury yield against the FTSE All World Index. A long-term trend in bond yields going down appears to have been broken, and perhaps, therefore, a long-term uptrend in equity prices has been broken, at least temporarily. Certainly the last 12 months, that picture's pretty clear, even if we know that the past is no guarantee for the future. And this matters because, in the end, all assets are priced off the risk-free rate, and that is generally the US Treasury, or it could be the UK 10-year gilt. If you can get 4 or 5% nominally risk-free, because the US government's never defaulted on its debt, it always pays its interest, it always returns the principal, some investors and clients could be forgiven for wondering why they need to take more risk in the form of corporate bonds or equities or anything else for that matter. So, money is now being repriced. Having held the cost of money and the price of money at zero for nearly 14 years, money now has a cost again, and maybe people are having to treat it with more reverence. That's why they're taking less risk. That's why risk premia are going up, and therefore, how does something reprice itself to make itself more attractive relative to the risk-free rate? Well, it goes down in price, and that's what we've seen with bonds, with equities, and other things beside. Now, central bankers may not necessarily have thoroughly worked out the implications of some of their policies, but hard to believe as it may be, a 1970s author actually foresaw it. Douglas Adams wrote The Hitchhiker's Guide to the Galaxy in the late 1970s, and in one scene of the initial book, the planet Golga Frinchen decides to get rid of a third of its population because they're frankly a bit useless and clogging things up. So they pack onto a ship telephone directory salesmen, insurance salesmen, hairdressers and all sorts of other people, tell them the planet's about to be destroyed and that they're going to lead the way to found a brave new world. So they pack them off and then they'll stay home and let them get on with it. The useless third of the Golga Frinchen populace lands on Earth. They quickly realise they need several things, one of which is money. Now, being a bit thick and also a bit desperate, they decide that a perfect currency is leaves. So they all award themselves lots and lots of leaves, and they're all incredibly rich, with the unfortunate consequence that there is inflation. And within a week, it takes 3 deciduous forests to buy a ship's peanut. Therefore, they have to try and rein in the inflation. How do they do that? They start to burn down the forests. And that's where we are now with central banks. They've handed out the leaves. Now they're trying to burn down the forests because they're trying to withdraw some of that stimulus. Now, they probably want to don't go for the full-on incendiary solution, but you can see the impact of less cheap money, more expensive money, less risk appetite, more caution. You can see it in the Bitcoin price. You can see it in the aggregate market capitalization of Microsoft, Apple, Amazon, Meta, Netflix, Alphabet. That's gone down by $3.6 trillion in the space of a year. That's just $3.6 billion that's just gone. Poof. Now, you could argue it wasn't real money in the first place. It was all stimulus money and cheap money, but nevertheless, it was there at one stage and it's been misallocated. Bitcoin, you can actually argue, over the past few weeks has been remarkably stable, given what's happened to the FTX platform and exchange. If you said to me that the world's second or third biggest investment platform or stock exchange would go bust, I'd be pretty confident in predicting absolute mayhem in stock markets. Bitcoin's barely flickered, so we shall see. But generally speaking, when things behave in an unusual way, relative to your expectations, it means you haven't got all the information. So I'm clearly missing something, and I look forward to finding out what it is. But what I can see on this slide is lower risk appetite because of an increased cost of money, an increased price of money after a 14-year span where money had no cost at all. So not surprisingly, it wasn't treated with much reverence. So central banks, what will cause them to keep on hiking? Or will they pause and will they pivot? Well, you can argue the case for either, and I'm not saying they've got an easy job, but they've certainly made it harder for themselves by leaving things so low for so long. You can argue on the potential inflation boosters, China reopening after COVID and a major lockdown could be inflationary as it starts to suck in goods and operate at full cylinders again. You can argue that deglobalisation is inflationary as we stop using Vietnamese and Bangladeshi workers and pay more expensive Westerners to do the same job. Energy is potentially inflationary, just look at the oil and gas price. Labour strikes here in the UK, you've even seen them in the US. Wages go up, potentially inflationary. Understandably, Labour wants some protection from inflation. And then war, I'm afraid to say, is potentially inflationary because it disrupts supply chains. Pause or pivot, what could cause disinflation or, heaven forbid, even deflation? Austerity will probably slow our economy down, as Jeremy Hunt's probably going to be quite keen to be pointing out in the next few weeks. Debt is inherently deflationary because money is paid to fund the interest rather than more productive projects. A mild winter would help on the oil and gas prices. That's probably the big trump card for central banks if we get it. Politics. Okay, maybe not deflationary, but if you give a politician a choice between taking their chances with inflation or deflation, what would it be? Well, my guess is they'd probably rather chance their arm with inflation, not deflation. People are going to be angry if they get their grocery basket going up, even angrier if they lose their job. So I think politicians will probably take their chances with inflation. And then recession, inherently disinflationary as economic activity shrinks. Where are we now? This is from Bank of America Merrill Lynch, very useful, showing when the Fed has previously turned turtle, changed its mind on policy and started cutting again. As you can see, we're nowhere near any of the trigger points, except in the MOVE, which is a bond volatility index. We got pretty near it with VIX, an equity volatility index. But the economic fundamentals at the moment don't really command a cut. But equally, it wouldn't be the biggest shock in the world if financial market volatility were to prompt some action. And listening to Mr. de Guindos's speech on the European Financial Stability paper from the ECB in mid-November, he was already talking about behaving prudently with interest rates and quantitative tightening. We've already heard Fed officials say that 50 basis points is enough at the next meeting. We've heard Andrew Bailey of the Bank of England say well, they think inflation is going to start cooling. It's almost as if they're starting to lay the ground for that pause and pivot already. And I suspect that, again, they're more worried about deflation and unemployment and be more willing to take their chances with inflation. And if you're the government and you owe £2.4 trillion like ours does, inflation actually helps get your debt to GDP ratio down after all. So it may be a part of their end game. Which are the lead indicators to follow to simplify that for you? Well, oil and gas is clearly one. They've been a huge part of the inflation story and could remain so if they stay elevated. And equally, if you're looking for a real pointer, don't listen to what central banks are saying. Look at the 2-year Treasury yield and the 2-year gilt yield. They lead central bank interest rate setting by 6 to 9 months. The Fed spends $6 billion a year in economists. All you have to do is switch on your Bloomberg screen and look at the 2-year yield. You don't need any of them, frankly. I know that seems a bit controversial perhaps, but watch the 2-year yields. They will give you a feel for if that pause or pivot are coming. And why is this all important? Well, it's because in the end, the one thing that Liz Truss and Kwasi Kwarteng made obvious here in the UK is that there is no money. That 2.4 trillion national debt limits the government's room for manoeuvre to do what it wants to do. Their idea of growing their way out of the debt actually made sense, but the cavalier, candid way that it went about it meant that there was no faith in the plan. And as this fraudster Charles Ponzi once said, they don't care if you're insolvent if they can't see you're insolvent. But what Truss and Kwarteng made clear was there was no money. So if there is to be money, it's going to have to come from somewhere. It certainly isn't going to be growth. Austerity, you can try it, but that's not going to grow things. In the end, it'll probably come from cheaper money, again, somewhere down the road. And hence this comment from Shane Maguire, who used to run the Texas Teachers Pension Fund, an absolutely massive one. I don't think the question is what gold's worth, but what currencies aren't worth. And this is where we come to our piece of the action, to square the circle from Star Trek at the start. Money and therefore risk assets have been mispriced for quite a long stretch because of QE and ZERP. They're now being repriced as inflation forces central banks' hands to raise interest rates and try and restrain QE or even go for QT. Now we've got risk assets praying for a pause or a pivot after a 1/5 slide in the S&P, a 1/3 slide in the Nasdaq, carnage in cryptocurrencies and emerging markets. Debt does box central banks in. When UK inflation last reached 11.1%, the base rate was 14%. It's currently what, 2 and change, 3? It's not going to get to 14, absolutely no chance. The economy would fall apart. But maybe 5% is the new 14%. And that's maybe when you do get the pause and the pivot. But at the moment, at least, they feel to me like they're positioning themselves for a pause and a pivot with their body language and some of their comments. Let's see what happens. And I think, in the end, given the debt that's out there, My inclination is to believe they'll take their chances with inflation and try and gun the economy at the first possible chance that the inflation data gives them, i.e. a bit of a peak and a bit of a softening, even if it isn't anywhere near their 2% targets. And if that's the case, and I've no crystal ball, I can't guarantee it, but it just feels the way the mood music's going, two things to watch. One, the performance of real stuff, real assets, commodities relative to paper ones like bonds and cash or leaves. Well, this, the more this line in the top left-hand corner goes up, the stronger the relative performance of commodities to equities. The lower the line goes, the stronger the relative performance of equities to commodities. Yes, commodities have run off with it in the last year and a bit, nowhere near their all-time highs. So if central banks do try and gun the economy and take their chances with inflation, this is where you could end up with more commodity outperformance, if. And then in the bottom corner, the one thing that will tell you really what commodities could be doing a cooking is the share price of Archer Daniels Midland, a commodities broker, banging at an all-time high. If it breaks out above that double peak, really could be telling you something. Equally, if it reverses and turns into a double top, maybe that's telling you that actually the economy is going to really slow, that inflation is going to come off, and central banks could be able to manage that inflation, could be able to manage the soft landing while restraining inflation. But again, like Burton and Taylor, second time round, it wasn't quite so much fun. And after they're making a mess of their transitory story, we need to be very careful about buying into the soft landing story this time around. Let's wait and see.
Thank you, Russ. Amazing. Now, up next, we're talking infrastructure and the part it can play in successful portfolios. Let's be honest, the current geopolitical situation has highlighted the importance of energy security, and infrastructure is clearly at the heart of the solution. Talking us through how to leverage compelling opportunities to the benefit of clients, ladies and gentlemen, Alex Arajo, Fund Manager at M&G Investments.
Hello, I'm Alex Arajo, Fund Manager of the M&G Global Listed Infrastructure Fund. And please allow me to be bold enough to suggest that this very exciting asset class, listed infrastructure, is at the heart of the solution to a number of society's issues, namely climate change, energy security, government inaction, and that elephant in the room affecting all of us, inflation. Starting with climate change, let's go to California for an example of how climate change is actually impacting companies and assets, and how climate change is actually really starting to hurt. So if we go to California and we observe the dryness and the temperature, in terms of heat, over the centuries since the late 1800s, we can see that the range of dryness and heat in the state of California has fallen within a relatively normal range for a number of decades up until the First World War. Subsequently, we've seen that the summers have become hotter and drier up until recently, where they've become so hot and so dry that they have caused quite an enormous and indisputable climate change related effect, namely forest fires. Why is this important, other than the catastrophe and the drama around forest fires, the loss of human life, and so on, obviously being the most important elements? But it's actually starting to affect businesses, investments, assets, like infrastructure assets. And I'm, again, bold enough to suggest that we have now seen our first large-scale victim of climate change in the corporate world, a company called Pacific Gas and Electric, which back in 2018 and 17 was implicated, associated with forest fires in California, was forced to take a write-down on its assets during the first forest fire in 2017, had to eliminate its dividend, ultimately was affected and seen to be liable for causing forest fires, in fact, in late 2018, and ultimately having faced bankruptcy. So that's a utility business, obviously a business and a type of company that is exposed to climate change-related risk, which we must be acutely aware of. But as it happens, the sector is actually at the center of the solution to climate change, with roughly half of the investment being made in renewable energy and less carbon-intensive solutions for society being made by the utility sector. And that happens to be one of the most important and prominent sectors in our approach to investing in listed infrastructure. So when it comes to the energy transition, we need a number of initiatives and investments, namely renewable energy, transmission networks in terms of long-haul transportation of electricity, reconfiguration of national grids, low-voltage networks, which is the local networks that serve us and our households to accommodate the electrification of transportation, self-generated power, smart networks, and ultimately, if we can get there, the electrification of heat, primarily through heat exchangers or heat pumps as a new and emerging technology. All of this requires significant infrastructure investment over the medium to long term. But in the meantime, our most acute problem is with regards to the access to gas. And we're all very much aware of the conflict in Eastern Europe, the issue around access to what used to be plentiful and cheap Russian gas, with countries around the world now scrambling, and particularly in Europe, to access other forms or other sources of natural gas. And since we launched the Global Listed Infrastructure Fund, we've always taken a very constructive view on natural gas, primarily thinking of it as an incredibly important transition fuel to displace coal-fired power, coal-fired heat. But today, it's all about capturing the gas value chain. And we do so through our various investments, including in the upstream, where we capture a royalty on gas production. We then transport that gas through long-haul pipelines. We liquefy that gas, regasify it, typically in Asia, but more recently, there's of course been a significant demand for that gas in this part of the world, here in Europe, for reasons that we're all very much aware of. And that incredible demand and the relatively scarce supply has only resulted in one outcome, which is a very, very high cost of the natural gas, which of course we're all having to face through higher energy costs. And it's very important to be able to capture that value chain, to be able to protect investors in the fund from that kind of effect, the rising cost of energy and more broadly inflation. So what's being done about it? And the sad answer to that is not very much. We're in the midst of the COP27 conference, yet another gathering of politicians and policymakers seeking to try to make a difference. But unfortunately, policy measures aren't meeting requirements. So the path to limiting global warming to 1.5 degrees Celsius requires quite a significant reduction in greenhouse gases. To even limit it to 2 degrees is again a similar profile in terms of reduction of CO2. And government pledges promise a lot. In fact, government pledges from around the world are roughly putting us in between 1.5 and 2 degrees C of global warming. But the policies that are actually in place, not so much the pledges, but the policies haven't changed a thing, and on the current trajectory won't change very much. So we actually require private investment, investors like yourselves and myself, to make a difference. And we do that through investing in these infrastructure assets, seeking to engender the energy transition and ensure energy security. And on the point of inflation, we can come to the fund itself and how it tends to do so. What we focus on in this strategy is physical assets, critical infrastructure, long life concessions, and perpetual royalties, where the physical infrastructure asset is actually land-based holdings. And we seek to grow the income to our unit holders every year in base currency terms on the back of growing dividends from the companies that we invest in. And we invest across 3 broad areas of infrastructure: traditional economic infrastructure, areas that are very familiar to most people; social infrastructure, critically providing for the needs of society, particularly around healthcare infrastructure, and then quite excitingly, evolving infrastructure assets that seek to capture long-term structural growth trends in new areas of infrastructure to serve an increasingly virtual and digital economy, primarily in the area of communications infrastructure. Always looking for a growing income stream, growing cash flows, and ultimately growing dividends to provide a total return for investors that ultimately exceeds the global equity market. That's a key objective. And as we celebrate our 5-year anniversary on the fund, we're very happy to report that the strategy has delivered a total return over and above the global equity market and well above the listed infrastructure peer group. And one of the ways that we've managed to do that is by delivering growth in an income stream in excess of the inflation rate. So since we launched the fund, roughly a 7.5% per year increase in income to the unit holder against a 4.5% roughly growth rate in inflation. Obviously much higher than that today, with the fund looking to protect against the kind of inflation that households are currently experiencing. And taking a long-term view, having spoken about renewable energy, the energy transition, and energy security, it's important to highlight other structural long-term drivers to this very exciting asset class, namely the electrification of transportation, increasing urbanization trends, particularly in developing markets, the need for more and better and broader and higher capacity digital connectivity, the need for a more circular economy through water and waste recycling infrastructure investments, healthcare infrastructure, and ultimately, in an aging society, demographic trends that drive the need for new and different types of social infrastructure. I hope you agree with me that it's an exciting asset class, an asset class that is designed and can help solve a number of society's issues well into the future. And with that, I thank you for your attention, and I wish you a good day.
Thank you, Alex. I'm pleased to welcome our next speaker, Aberdeen's Investment Director, Kirsty Desson. In her session, where small caps are big news, Kirsty will delve into the biggest opportunities currently available for smaller companies. She'll look at why an active approach suits smaller companies, provide an outlook for global smaller companies, and investigate what needs to happen to drive a recovery. Ladies and gentlemen, Kirsty Desson.
Hello, my name is Kirsty Desson and I am the manager of the Aberdeen Global Smaller Companies Fund. Today I'd like to share with you my thoughts about the global small cap asset class. So firstly and most importantly, why now? Well, very simply, small caps outperform large caps in recovery periods. If we look back at the GFC and the post-tech bubble period, what you'll see is that in the 1 and 3 year periods following the downturn, small caps significantly outperformed large caps over those periods. If we look at the numbers in more detail, what you'll find is that small caps outperformed large caps to the tune of between 40% and 120% over those periods. More importantly, what you see is that inflection from a downturn into an upturn tends to occur within the first 3 months of a recession. So whilst there's a lot of debate still going on right now about where we are in terms of the downturn, what's safe to say is that now is a very opportune time for investors to be starting to think about an allocation to small cap. Moreover, if you look at what's happened year to date, what you'll see is that large caps and small caps have underperformed to around the same extent. In a global context, both large caps and small caps have come off around 17% in US dollar terms. And this is typically what we see in downturn periods, that small and large caps underperform to the same extent. But what you will find is that small caps are trading at a significant discount to large cap. And in fact, the relative valuation gap now is wider than in previous down cycles. So why global small cap? Let me give you a little bit of background about the asset class. So even though it's only 15% of the global market cap, it actually accounts for 2/3 of the world's companies. That is 6,000 stocks. So it's a very rich and diverse picking ground for investors. It's home to some of the world's most innovative companies, household brands, and world-leading companies with specialist know-how. It also tends to be less well covered than the large cap universe. So what you find in small cap is that there's on average around 6 analysts per stock, whereas in large cap there's around 22 analysts per stock. So for investors with an active and disciplined investment approach, there is significant scope to exploit the opportunities we find in the small cap universe. Smaller companies, by their nature, tend to be at an earlier stage of their development than large caps. And therefore, we tend to see higher growth in small caps versus large caps. They also tend to be more niche focused and more nimble. It's therefore not necessarily surprising that small caps outperform large caps over the long term. So where do we see the opportunities? If we look at where valuations are, what we'll find is that certainly in the UK, the US and European markets, small cap growth stocks are trading well below their long run averages. Indeed, in these markets, valuations are at or below the one standard deviation below their 10-year PEs, and that is creating enormous opportunities. As long-term investors, we're very much focused on finding great companies that can benefit from long-term structural growth themes. And the areas where we're finding continued investment are in areas such as automation. Certainly the recent labour tightness has put a spotlight on automation for companies. Japan has very much led the way on this, and we expect the rest of the world to follow. So companies like AdTech in Sweden, also Jungheinrich that makes forklift trucks for factory automation, are both benefiting from this theme. Similarly, we find multi-year growth trends in the likes of energy solutions. If we look at Taiwanese companies like Voltronic that make solar inverters, or GTT that has specialist knowledge in how companies can transport LNG around the world, we see these companies as having many years of growth ahead. We'd also point to companies that can provide innovative healthcare solutions like Insulet, which makes pumps for diabetes sufferers. This is a life-changing technology where users depend on Insulet's technology for many, many years to come, and that gives them an enormous visibility in terms of their revenue. So these are the kind of companies that we're focusing on that have resilient growth trends. Thank you for your time.
Kirsty, thank you for that session. Now, any questions for Kirsty or indeed any of our speakers so far, don't forget to note them in the chat function or write them down on that feedback form which will be popping up at the end. Now, today we're delighted to welcome this group to Investival for their debut feature, and they've sent their head of investments, Mark Rogers, to take the spotlight, and rightly so, as he delivered undeniably the best titled session of the day. OMG, it's ESG. Now, love it or loathe it, the headlines emerging from COP27 suggest it's still a big ticket. Talking it through what's going on and what investors are supposed to do about it, ladies and gentlemen, it's Montenaro's Mark Rogers.
Hello everyone, my name's Mark Rogers and I'm going to speak to you about ESG. I am going to introduce the concept of ESG to you, then we're going to go through the history and evolution of that in a historical context, and then I'm going to try and discuss where we are with ESG and what we think of the future. Having said all of that, I want you to forget about ESG and just think of a world where everyone has become obsessed with eating vegetables. And everyone is very peaceful in this society until someone comes along and invents a vegetable eating contest. And why this is important is we must now try and understand how society changes in, if you like, its happiness index, as all the different players in this vegetable eating contest appear on the scene. First, you have the competitors, who are the vegetable eaters. And part of this vegetable contest, there are no rules. So these people have to decide for themselves how they're going to win. And you can have people who begin by eating or turn themselves into vegetarians, and more competitive people will decide just to eat curly kale and spinach. But there are a group of other people who think they found a loophole in that they can eat pizzas and they can net off the pepperoni with the tomato base of the pizza. And if they eat enough pizzas, they can win the competition. The next players that arrive on the scene are the associations and the societies, which try and sell membership to the people in the competition, and they offer them badges and logos that they can sew onto their clothing to try and make them feel enamored and empowered that the way they're eating vegetables is the right way of doing things. Next on the scene, we have the agencies who don't enter the competition themselves, but they rate the vegetables. And at first, people are enlightened by this because it will give some structure and uniformity to the competition. But they soon realize that one rating agency will give broccoli 5 stars and another rating agency will give broccoli 1 star. So there's no consistency in these agencies. And what you find in the happiness index is we've gone from a peaceful society to a rather tetchy society, as people find that they're being told what to do by other people. And so you find that the government steps in. They're the next player in the market, and they decide to set rules and regulations. They hire regulators, and they decide for themselves which are the rules that people should follow. But the problem with these is they find, after consulting with society, that a rather large amount of people eat pizzas, and you can't lock up all the pizza eaters because it's just impractical. So part of the rules of the vegetable eating contest is you can actually eat pepperoni. And this infuriates the vegetable eaters who are particularly eating curly kale, but it also infuriates the people who aren't in the competition. These are the final players, the people who hate vegetables, because they find that they're suddenly told to disclose what it is they're eating, and they even think that they might eat vegetables themselves. And so you've gone from a very peaceful society to a fractious society. And why I use this analogy of vegetable eating is it's trying to show you that ESG is political, and it is politicized investing. And we need to decide if this is right, if this is normal, or if this is wrong. And so now we have to explore capitalism as the next concept in this argument about ESG investing. Now, capitalism is the economic structure we operate in at the moment, but it's rather an odd one because it operates by the market system. What we mean here is that it is an automatic allocation system. If you like, it's rather like autonomous driving, where the cars decide for themselves based on algorithms which are put into them how best to drive people around town. But no one necessarily has confidence in these algorithms, and so there's always some sort of human oversight. But in the world of capitalism, or as it's purely described, we don't have this. And this is at the core of ESG investing, because this self-interest that comes out of the market system is a paradoxical solution to survival within a social group. We as humans survive in a social group. And if you believe in pure capitalism, then you don't believe in ESG, because you believe that self-interest is the guiding principle of society. And we must now look at economic history to decide if we think this is right. Now, the worldly philosophers who've been explaining capitalism start off with Adam Smith in 1750, when we come out of the Industrial Revolution. And I've listed all the great economists of the time, and the ones above the line are what I would call very loosely the economists who believe in purebred capitalism. And so in all probability, they would be the ones who feel that ESG should be left alone and we should let capitalism decide how society progresses. But there are a number of other very well-known and dignified economists of our time who are shown below the line, and they're the ones who have been saying in their essays of economics that capitalism is rather fickle, and rather like autonomous driving, it does need oversight from human society to make sure that it's kept in steering in the right direction. Thomas Malthus was actually the first one who enlightened us to the notion that we need to be very careful of the environmental resources as population grows. And David Ricardo and John Mill believed that capitalism had vested interests, which meant that land, labour and capital weren't operating in unison with each other, such that society might create wealth efficiently within capitalism, but it might not distribute wealth efficiently. And so people need to correct this error in the distribution of the wealth in society. So to try and summarise where we've got to at the moment, we've said that in a free and democratic world, one has to expect ESG to be political. That's normal. And also, capitalism is a fickle instrument, and we need to expect it to be guided by humans to make sure that we don't end up in socialism or communism. So now we need to find out where we are in today's world. And I've broadly split the demographics into three sections. First, I'm going to deal with the hippies. And one must always remember that people's beliefs are set by their informative years of their youth. And in the hippies, they came out of the war, the Vietnam War, and they were the ones who were anti-war, they were anti-consumerism that they were experiencing in the 50s, and they were into equality. And so they were very much supportive of the ESG world we have today. Next up, you have the punks. And they were informed by the era in the 70s and the early 80s, which was economic malaise and high inflation. So it's naturally to be expected that this generation of society at the moment is much more focused on monetary stability and economic wealth, and they are more likely to be anti-ESG in today's society. And finally, you have the youth of today, which I've called the woke. So I do apologise for those people who don't like that expression, but in the Oxford English Dictionary, it does mean enlightened. And this group is very much like the hippies. They have the same beliefs in the environment and in an equal society and in stakeholder capital. If you try and find out where this comes from, it must be some explanation that they have problems with the hopes and opportunities that they face going forward. And so it's very important that their aspirations on life are taken into consideration to make sure that capitalism remains stable in our society. So looking forward, we need to make sure that savers are free to save as they wish to maintain that we are in a free democratic society. We must make sure that capitalism is healthy because it's the best system for economic progress. But we must also remember that it's fickle, and we need sustainability and we need management of ESG to make sure that it's been steered in the right direction so that the whole of society feel as though they are content living in the world of capitalism. Now, in terms of the changes in which you see in society, change can come about from a number of places. And in a capitalist world, power, which is the influencer that makes change happen, follows wealth. And one must expect that as wealth transfers to the youth of today, and if the youth of today maintain their ESG credentials as the hippies did, that change will lead us to a world where ESG becomes a more important factor in how investors must allocate capital. One must also expect that only a very small percentage of the population who wish to protest peacefully can be seen to make change happen across society in a very positive way. And so we must also follow and expect that to happen. And why I introduce that is an academic study in 2001 has shown us that it takes only a small amount of the investing community to decide to invest in ESG companies, to make ESG companies have a more beneficial cost of capital, which drives their wealth. And the more people that switch over to ESG investing, by that very nature of happening, will enhance the value of ESG compliant companies to the point that non-ESG companies will feel it's worth their while to make that switch. Now, we can also expect ESG to actually drive capitalism, because as we know from Keynesian economics, savings equals investing. And if our savers are directing capital into the world of sustainability and ESG, they are also directing investment into that space. And this chart shows you from the UN that to abide by the UN SDGs, which is all about improving society and making it a better world, there is an awful lot of investment, up to $12 trillion, which is needed to make the world move into a more harmonious place. Now, we can see this happening already because this shows you the allocation of investment that is going into ESG versus non-ESG. And we're already up at a 50% split. And we can start to see that ESG is having a very positive impact now on the valuation that people are attaching to companies. So I want to leave you with my conclusion, which is that we are at a very exciting moment in time for investing. And if I can go back to my initial analogy, if your savers come to ask you what to do, you must tell them that they should eat vegetables. Thank you very much.
Thank you, Mark. Next up is Dr. Christopher Meller, Invesco's Head of ETF Equity and Commodity Product Management. Now, I know there'll be plenty watching who'll have tuned in particularly interested in what's going to be said in this session entitled, Is Blockchain the Future? Well, our next speaker thinks potentially so, stating you could draw a number of comparisons between the launch of the internet and blockchain. Paved with uncertainty, but with potential of great success, those companies who found new ways to use the technology are now among the largest in the world. With blockchain technology still in its early days, Dr. Christopher Meller looks at the potential for changing the global economy and considers if it's actually underappreciated by the market. Could there be an opportunity for investors to capture this hidden potential? Well, let's find out, shall we?
Hello, I'm Chris Meller and I'm Head of Equity and Commodity Product Management for the ETF business at Invesco. Today I'm going to be talking about the transformative potential of blockchain. So first of all, what is blockchain? Blockchain is actually a remarkably boring form of technology. A blockchain is just a form of ledger or a record of all of the transactions and balances in a given system. What makes blockchain interesting though is that there is a cryptographic element layered on top of that ledger that allows any participant looking at that record to be able to identify whether that ledger has been changed or tampered with. That's a very powerful thing that you can do. What it does is it means that different participants can share the same records and actually trust the quality of that record keeping. And it's that ability to introduce trust that makes blockchain so powerful. It gives it the potential to bring the properties of asset transfer in the physical world into the digital world. There are two types of blockchain, a public or open blockchain and a private or closed blockchain. They only differ in how you add transactions to that record. The public is an open and permissionless system, and it's the technology that sits behind crypto assets today. Private is much more similar to a regular corporate network where permissions are set by a central authority. But both have significant potential to change the way that we live. If we look at the potential there, what is the potential for blockchain? And one way that it's been described is to compare it to the internet and think about it as the internet for assets. So if we think about what the internet did, it reduced by several orders of magnitude the costs involved in making, storing and transferring information. And whilst doing that, it also transformed the way we live and also made a lot of companies a lot of money. At the same time, blockchain is effectively doing the same thing for assets. It has the potential to transform the way that we store assets, record assets, and even transfer assets, and again, fundamentally change the way that we behave as a society. If you think about, again, the analogy with the internet, if you look at the internet space, the first use of the internet was open and permissionless. That was the email system and used for simple transfer of information. The first and most obvious use of blockchain has been crypto assets, and again, it's an open and permissionless system and used for largely simple transactions. The next stage with the internet was many companies coming in that were again looking at how you use information, transfer information and consume information, and again there were a large number of opportunities and household names that we know that have made significant profits and make significant profits today. Again, for the blockchain situation, it's a very similar story. There are many companies out there today that are looking at different ways of using blockchain and applying them today to improve that use, transfer and storage of digital assets. If we think about those uses, on the screen now are some examples of headlines from recent newspaper stories talking about blockchain. Blockchain, it's worth saying, is so much more than just cryptocurrencies. Cryptocurrencies is the first and most obvious use, but there's a wide array of opportunities out there, from improving cyber security, from changing the way that back office transactions or financial transactions are recorded, and improving speed and reducing cost. Also, one of my favourite examples is the impact that it has on supply chains. For example, the use of blockchain technology in the food trust network, which is tracking movements of food through the supply chains from the largest producers through to the largest retailers, helping to reduce cost, helping to reduce wastage, and also helping to improve safety and health. So, blockchain is a real theme. It's here today, and it's really starting to have an impact on the way we live. It's also has a strong potential as an investment as well. And if you think about the investment in blockchain, most people might jump to the conclusion that you could invest in crypto as a way of getting exposure. But the reality is, crypto assets are enabled by blockchain technology, but they're subject purely to the supply-demand dynamics in those particular markets. So much like gold, they'll be driven by how many people are looking to buy and how many are looking to sell at a given time. If you're looking for growth in the theme itself, it's much better to look at the equity market. And the key thing is that there are today companies out there that are making real earnings from blockchain-related activities, whether that's companies linked to the crypto space, or whether that's companies involved in the private blockchain exposure as well. And the key things that an equity investment are offering here are a high level of liquidity, so tradable stocks traded on public exchanges. Secondly, you can actually see and measure the earnings and the business activity that's going on in the background. And then thirdly, you can also build an effective and diversified portfolio, not only diversified in the sense that it's giving exposure to different parts of the blockchain opportunity set, but also diversified in the traditional asset allocation sense, building a portfolio that is not taking exposure too focused or concentrating exposure to a particular stock or stocks. How do you identify stocks? And with any thematic investment, that's a key part of the process. The way that we're doing it with our approach is to partner with experts in the field, so working with CoinShares, who are Europe's largest digital asset specialist. And it's the CoinShares analyst team that are doing the legwork, digging into the companies, looking at those companies and identifying their potential exposure to blockchain and their potential inclusion in the index. How are they doing it? It's a very sort of formulaic, bottom-up analytical approach. So looking at stocks and assessing, their potential earnings that they could derive from blockchain activity, how competitive they are in that particular space, what proportion of earnings are currently coming from and are likely to come from in the future, and similar measurable, gaugeable metrics that they're using, analysing those stocks to identify and ultimately apply a blockchain category score that's fed into the index. So that's the analysis that's going on behind this. What sort of stocks are you getting exposure to? So CoinShares analysts have identified 8 key areas that have exposure to the blockchain story within business activities, going at the top of this slide from if you like, the private or closed blockchain types of solutions, so blockchain technology, right down to the bottom of business activity areas much more involved in the public or open blockchain businesses around crypto assets. And there's a wide range of different types of companies that are coming into the index there. In terms of exposure, we normally think of these things as around a third. So a third of the companies or a third of the weight in the index is, pretty much directly exposed to the crypto asset business in various forms. A third are entirely devoted to the enterprise blockchain or private blockchain solutions, and a third sort of sit in the middle and are involved in both sides of the blockchain story. To give you some examples of stocks, the first that's on the screen now is a company called Bitfarms Limited. This is a Canadian cryptocurrency miner that's focused exclusively on mining Bitcoin. It's a relatively small cap stock with just under $1 billion of assets, $1 billion market cap at the start of 2022, and is pretty directly related to the movements in the crypto asset markets. A Bitcoin miner is involved in adding transactions to the cryptocurrency blockchain and are paid in that native cryptocurrency, in this case Bitcoin, for the activity that they're doing. So clearly they're probably one of the most exposed stocks in the index to the fluctuations in crypto asset prices. The next example is perhaps something more of a household name, which is CME Group. So CME is the Chicago Mercantile Exchange. It's the world's largest derivatives exchange provider, and their involvement in blockchain activity comes again as a link to crypto asset markets, but it's a slightly different link to the previous example. In the case of CME, CME offers trading in futures linked to the price of Bitcoin or to the price of Ethereum. So the CME group don't really care in terms of profitability whether the price of Bitcoin goes up or Ethereum goes up or the price of cryptocurrencies go down. What they care about is the volume of activity traded on their exchange, as they're paid a fee for every transaction that is done. If you look at the volume of activity that's been happening in crypto assets since the start of 2021, when crypto assets were close to a peak, to today's levels, you've seen a doubling in the volume of activity, for example, in Bitcoin futures contracts, despite the fact that crypto asset prices have dropped by 60 or 70% over that period. The final example I'd give is again something of a household name, which is IBM. Most people will recognise IBM and link it to mainframe computers or indeed home computing. It's been a while since IBM's been involved in that. They sold their computing business off, the hardware business off, and they're now pretty much a pure play tech consulting firm. Their crypto asset blockchain exposure comes from that consulting business. They're one of the world's leading consultancies involved in helping corporations add blockchain use to their record keeping and systems. The example I gave earlier, looking at the Food Trust Network, that's a system that is run by IBM's consulting business, and today IBM are accruing earnings from exactly that blockchain-related business activity. In terms of the investment, it is accessed via an index, and the index methodology is fairly straightforward. We've spoken about how the analysts are identifying stocks and assigning a blockchain category score to those stocks. The index is then constructed, selecting stocks based on their blockchain category score. and also weighting them based on that blockchain category score. So a stock with a higher exposure to blockchain activity is going to have a higher weight in the index. The index itself is subject to strict constraints around liquidity and size, and also concentration limits to ensure that it's investable and delivering the best possible combination of blockchain exposure whilst also being accessible for investors. In terms of the breakdown of the index, because we're weighting by blockchain category score, you see a greater exposure in terms of weight to higher scoring stocks than you would for based on purely number. So if we look at the number of stocks in the top 3 categories, it's something like a third of the stocks in the index are in the top 3 categories, but around about 50% of the weight in the index is coming from those stocks, with meaningful exposure to the highest scoring that you can see on the screen now. How does it look more broadly? Well, it's a broad and globally diversified index that we're talking about here, so meaningful exposure to a good mix of large cap, mid cap and small cap stocks, and as we've discussed already, a good mix of blockchain category exposures as well. It's also, as I say, diversified across sectors and across regions. Meaningful exposure to obviously tech and financials, which is where the heart of the blockchain opportunity sits, but also exposures to other parts of the market. And again, on a regional basis, a meaningful exposure to the US as the largest equity market in the world, but also a well-diversified exposure to other areas, Japan, South Korea, etc. Finally, I often say that the proof of the pudding is in the eating for a thematic ETF, and what I mean by that is that you should be able to see in the performance of the index a response when there are changes in appetite or changes in news flow around the theme that you're investing in. In the case of blockchain, probably the best indication of that activity at the moment is crypto asset prices, and the chart on the screen now, you can see the purple line is giving you the price of Bitcoin as just an indication of appetite or activity in that most public and visible part of the blockchain space. And you can see in dark blue the relative performance of the blockchain index relative to the MSCI World, so the broader global equity market, that there is a clear link between the performance of the blockchain index and that most visible use of the blockchain space. That does come with benefits and disadvantages. So during the boom of activity that we saw in 2020 and early 2021, we saw significant outperformance from the blockchain index. Obviously, we've had a more difficult period for crypto asset markets and crypto asset activity, which has been a drag on the relative performance of the blockchain index. As ever with long-term thematics, the key question is, are you getting exposure to that theme? And quite clearly, that's exactly what this index is doing. And if you believe in the long-term potential of blockchain, then this index is going to give you a meaningful exposure to that long-term growth opportunity.
Thank you, Christopher. So one more session for you before we grab a coffee break, and I'm sure the next 15 minutes will fly by. Senior Fund Manager Clive Beagles of J.O. Hambro joins us with his session titled, Why the UK? Clive will take a look at the reasons for investing in the UK and, despite economic uncertainty remaining high, where UK opportunities could lie. Is he also brave enough to provide his outlook for the coming months ahead? Well, let's listen in and see.
I'd like to talk to you about the UK Equity Income Fund at J.O. Hambro and actually how value investing in the UK has really become a minority sport in the last few years. As this slide here shows, the UK has underperformed quite significantly over the last 15 years or so relative to the global index. And many people put that down to politics, think about Brexit, think about how we dealt with COVID, more latterly think about the sort of omni-shambles of the UK budget of autumn 2022. But if you look at this chart, you can see that rather than it being about that, it's probably been about the fact that the UK market has a very heavy bias towards the value factor, and value relative to growth has underperformed very similarly to the way in which the UK has underperformed. And I think that's mainly because in post-financial crisis, we've really had a period of very low or indeed zero interest rates, which has allowed growth and particularly large cap technology stocks in the US to dominate global performance. But we think that situation is changing, and that's the reason why somewhere like the UK could well come back into favour. And you've seen that begun to change in the last 12 months or so. The other factor which I think is particularly important at the moment, as we're staring into a period in which we're likely to see a global downturn, is the valuation of cyclical stocks relative to defensives. As this chart here shows you, somewhat remarkably, cyclical stocks are on their lowest valuation compared to defensives across UK and Europe for 50 years. And if you think about all the economic issues that the world has had to deal with in the last 50 years, whether it's COVID, whether it's the financial crisis, whether it's the deep recessions of the early 80s, it feels to us that's quite extreme. Yes, there are some challenges that all companies and economies have got to deal with at the moment, but I don't think they're the worst that we've seen for 50 years. And again, that presents a big opportunity, particularly amongst sort of cyclicals with a value tilt. As we also said, the world has changed. We're now facing into a period of much higher interest rates, and this has very big implications for a whole raft of dynamics, not just the growth versus value, but also in particular how financials may behave. The financial sector has been deeply out of favour since the financial crisis in 2007-8, but now we're looking at a period of rising interest rates. Banks in particular can now make higher profits because they can earn a positive return on their deposits, and yet we've got a generation of investors who've never had to own financials and still don't own financials. They view them as too risky, even though these companies have become much safer from a balance sheet point of view and are about to have a decade of very strong net interest income growth ahead of us. So in that regard, we think banks and indeed insurance companies, which will also benefit from higher rates, and I'll touch on that in a moment or so, are clear beneficiaries of the new regime that we have now entered, and yet we find most investors still ignoring them and still finding them too complicated to become major parts of their portfolio. And with that in mind, it's very important to think about now is not a time to be passive. We showed you earlier on that defensives are very, very highly rated relative to other parts of the market. Those really are areas to avoid. And yet there are big sectors in the UK which we think look highly attractive. Insurers, banks, mining and oil make up around 50% of our fund. And I'm going to briefly explain on each of those four sectors why we find them so compelling. Firstly, the insurance sector. And here we're really talking about life insurance companies that in particular focus on the bulk purchase annuity market. The move up that we've seen in bond yields in the last sort of 9 months or so as central banks have begun to increase interest rates is very, very beneficial for the future business flow for this industry. Why? Because a number of companies who have been staring at pension deficits no longer have a deficit. Indeed, they often will now have a surplus. And they would like to take that risk off their balance sheet. And as a result, they'll take part in a large bulk purchase annuity transaction with the likes of an Aviva, a Phoenix or a Legal & General. At the same time, the regulation in the UK is changing. We're finally making good the fact that we're no longer in the EU, but that we can now set our own rules, and we're going to slightly change the Solvency II rules to allow these businesses to write more business with less capital. And yet this industry is being valued as if it's got no growth ahead of it. Most of the stocks here trade on very low multiples, 6-7 times earnings, very high dividend yields. To us, this is a tremendous opportunity which is being ignored by most investors. Elsewhere within financials, banks remains another core sector for us. I touched earlier on about the fact that people haven't felt the need to own banks, and you can see from the chart on the right-hand side why. Because for much of the last decade, banks haven't really distributed very much of their profits back to shareholders because there's been a big leakage, in particular towards paying fines, towards paying off PPI liabilities and the likes. But that situation is now changing, and banks are going to distribute an awful lot, much higher proportion of their operating profit back to shareholders via dividend distributions and share buybacks. To give you an example, we expect NatWest Bank to return 40% of its market cap over the next 2 years in one-off distributions and indeed its regular dividend distribution. Yes, we're entering into a period of recession. Is that dangerous for banks? That's something maybe we should consider. But we think the positive from higher interest rates and higher net interest income more than offsets any risks that we're going to see from a higher degree of provisioning and indeed subsequent bad debts. Elsewhere in the UK, we're also very excited about the two commodity sectors, both mining and oil, which are very international sectors, of course, and have very little direct correlation with the UK economy. First of all, mining, we think, is a sector which is being much more disciplined about its capital expenditure. It's no longer chasing a sort of Chinese infrastructure boom as it was during much of the previous decade. And you can see that from these charts on this slide, that they're actually spending much less than the cash they generate from their businesses, particularly on new exploration, and they've been returning a lot of that to shareholders. As a result, we think we're going to have extreme shortages of supply of a number of metals, particularly metals which are going to be very important for the energy transition. And copper, I think, is the most important one of those. Copper, because of its thermoconductivity attributes, is the key metal for the energy transition. You need a lot of copper to make your electric vehicle work in order to get electricity back from a offshore wind farm back to the country where it's going to be used, or up and down the country for recharging networks. And yet we're not finding very much new copper, and yet we're going to need probably 50 to 100% more per annum by the time we get to towards the end of the decade. So companies that have got a strong bias towards copper and other forward-looking metals like cobalt and lithium and nickel make up a core part of our portfolio, and the likes of Glencore is a key name in that regard. And then the last of the commodity sectors, being oil. We show here some charts about BP, where BP is sort of on the end of a lot of criticism, particularly from politicians, about excess profits that they're making. But BP are investing those excess profits that they're making at the moment in terms of accelerating their energy transition. They're investing an awful lot more in low carbon technologies, solar, wind, biodiesel. And you can see that progressively over the next decade, those will make up a greater and greater proportion of BP's profits. But they're also using some of those excess profits, if you like, from the current high energy complex to retire an awful lot of equity. And BP could almost buy back their entire market cap at the same time over the next decade. So reducing the number of shares in issue while making the business more future-proof in terms of investing in some of those new opportunities is a very strong combination for us. And that's why you find this is one of our largest holdings. When we look at the fund in aggregate, obviously we're an income fund. We're very proud of our dividend yield as well as our dividend growth record with this fund. And the left-hand side shows the long-term dividend growth path of our fund. And despite having a downturn both in 2008-9 and more latterly with COVID, when of course a lot of companies were restricted and prohibited from distributing dividends, we've still grown our dividend by on average 9% per annum since we began this fund almost 20 years ago. And yet the starting dividend yield today is somewhere between 5.5% and 6%. So if we could replicate that 9 to 10% growth in the next 10 years of a starting yield of nearly 6%, we think that income stream should be extremely attractive for a number of investors, whatever ambitions that they have in terms of their total return. And we also think that income is likely to make up a higher proportion of total return in the future years than it's made in the past. Just touching on ESG, we've got a slightly different perspective to a number of other investors. We're very much focused on trajectory of improvement. What do we mean by that? Well, we think that if a company can improve its ESG credentials, it's likely to lower its cost of capital, it's likely to be given a higher rating. And a number of the companies that we own, which may be in some of the more controversial areas like oil and mining, are showing very strong progress in terms of improving their ESG credentials, having a very clear path towards reducing their emissions progressively over the next 10 to 15 years. And Glencore would be a good example of that, a company that's had problems in the past with its relationship with stakeholders, whether they be regulators or governments, and indeed has had to pay some significant fines. But we've had major changes of personnel at Glencore, something that we have been very instrumental in bringing about. And yet it is also the company that is the best place to benefit from some of those future trends in terms of copper, cobalt, lithium, how important those metals will become. It's one of the largest miners of all three of those metals in the world. And if it can continue to improve its credentials, we think it will get progressively looked upon more favourably by the wider investment community. Now, I've been doing this job for nearly 30 years and been running the fund at J.A. Hambro for nearly 20. And this chart here is just to show you how unusual the current valuation agenda is. What we show you here is the price to book multiple for our entire fund. in blue relative to the average for the UK market in orange. And maybe just concentrating on the blue line, you can see in aggregate, we've only ever traded below book value twice in our history. During the financial crisis in 2008 and during the depths of COVID, when of course many businesses were in fact shut and were unable to trade. And this is, for us to be trading at a similar level today relative to those previous periods, to us just looks extraordinary, particularly when you consider that, as I touched on earlier on, balance sheets are very strong compared to where they've been in the past, and we think presents a great opportunity for us to produce not only a strong dividend yield, but also very strong capital growth from this starting point. So in summary, we think we're at the beginning of a regime shift. We've had zero interest rates for 15 years. That era is over. Interest rates are going up, but they're not going to come back down anytime soon. So cost of capital is no longer as low as it has been. That means that people will have to consider other styles of strategy other than just mega cap growth, which has been the dominant feature for the last 10 or 12 years or so. We think that's getting people to consider value-orientated strategies, of which ours would be one that they should consider. There aren't many people left doing what we do these days. Value has been so out of style for so many years that many managers who are doing it have retired or indeed been laid off. We've got a very healthy dividend yield on the fund, approaching 6% for 2022 and hopefully higher than that. Valuation opportunity is extremely positive. Most stocks in our fund, we think, have 50 to 75% upside, some more than that. And some of those are very large cap stocks. Most of the banks, we think, could and should double from here. And we've been doing this for a very long time. You've been running this fund here for 18 years, and as many of you know, ran a similar fund at Newton prior to that. So we've got a long heritage and history with this style of investing, which we think is now beginning to come back into favour. And we are the best performing fund in this sector since we launched in 2004. And with that in mind, even though the UK has been out of favour, value's been out of favour, we think now would be a good time for people to reconsider allocating towards styles and funds such as ours. Thanks very much for your attention.
Thank you, Clive. So that brings us to the halfway point and time for a cuppa. We'll see you back here in 5 minutes, just enough time to put the kettle on and top up the brew. See you shortly.
She'd say everything you want to dream away. We are legends every day. That's what she told me. Turn your magic on. To me she'd say everything you want to dream away. Under this pressure, under this way, we are diamonds. I feel my heart beating. I feel my heart underneath my skin. I feel my heart beating. You make me feel like I'm alive again. Like I'm alive again. You make me feel like I'm alive again. Said I can't go on, not in this way. I'm a dreamer, die by light of day. Gonna roll up half the sky and say we are omen. I feel my heart beating. I feel my heart underneath my skin. I feel my heart beating. You make me feel like I'm alive again.
Welcome back. Hopefully you're settled in and comfortable again for our second half. Now, these emails can wait for just a little longer. So kicking off our second half with a session titled Navigating the New World Disorder, I think we all need some help dealing with this year's choppy waters. But amidst all the uncertainty, Alexander Charters, Investment Director and Co-Fund Manager at Ruffer, is going to suggest what we can have conviction about and why recent market events have really challenged the financial services sector. Compass in hand, please welcome Alexander Charters.
Well, our topic today is crossing the Rubicon. When Caesar prepared to cross the real Rubicon in 49 BC, he paused because he knew that there was no going back once he made the trip across the river. We think that we're crossing the Rubicon into a new, more inflation-prone and volatile market era. Unlike Caesar, we don't get a choice about whether to go into that new era, but we do get a choice about how to deal with it, and that's what we're going to be talking about today. First, for those that don't know anything about Ruffer, we are a single strategy firm. We do one thing. We try and protect and grow our clients' capital in all market conditions. We do that for the full £26 billion we look after. We've been doing it for 27 years. We're a private business, so we're not answering to any outside interests. We're just interested in doing what's right for that long-term preservation of capital strategy. And that's what it looks like on the charts here. Ruffer in green, UK stocks in blue, 60-40 portfolio in orange, and cash, which is actually what we really care about because we have absolute, not relative objectives, in yellow. And the key thing to take away from this is we do not care what the market is doing. We simply care about preserving capital regardless of what gets thrown at us. And over the long run, that's generated a return of just under 9% net of fees. And we made positive returns in the dot-com crash, in the credit crunch, and more recently in the COVID crisis. And we've done that by getting the asset allocation right, a portfolio structure that can weather storms as well as sunnier times. But enough of that. The more interesting question is where we go from here in these extraordinary times. And I'm going to start with this remarkable place. This is Biosphere 2. It's a facility completed in 1991, and it was designed to test whether mankind could live in outer space in self-sustaining colonies. It's basically a giant greenhouse. But one of the things that researchers discovered was that trees grew unnaturally fast in this artificial environment. And they realized the reason was that there was no wind and no weather. No wind and no weather means trees didn't develop reaction wood, so they were free to grow quickly, but that reaction wood is what helps them weather bad weather. And as a result, they collapsed under their own weight. Now, we think that markets have been living in something like the Biosphere era. Low inflation, low interest rates, low volatility means people are not conditioned for resilience. They're optimized to historically benign conditions that we don't think will last. Why has it been such a remarkably benign era? Well, there have been many drivers. Lots of them are on here. We think these are the most important. China plugging back into the global economy from 78 onwards, the end of the Cold War, the small state revolution spearheaded by Thatcher and Reagan in favor of free trade and markets, technologies, influence, favorable demography, and central banks focusing on inflation. And that added up to disinflationary globalization. That's been a golden age for capital. In fact, here you can see the long-term cyclically adjusted price-earnings ratio in blue of US stocks. There's a Cold War average and a post-Cold War average that's much higher. And you can see there the long-term US interest rate as proxied by the 10-year falling for 40 years. Assets love low inflation, low interest rates, and low volatility. And we've had them in spades for 40 years because of those factors. So assets have gone up really quickly, but so has debt. Here is advanced economy debt in green and emerging market debt in blue going back 140 years. As at today, in 2022, we are at World War II levels of debt to GDP, and we haven't even had a conflict. What this chart is really telling you is that the chances of you being paid back any money you're lending, for example, to governments, in real terms, so adjusted for inflation, are extremely small. Instead, financial repression is going to be the order of the day. That's an environment where interest rates are held forcibly below the level of inflation over the long run. Doesn't mean they can't cross over short term, does mean it's not sustainable in a highly indebted economy. Here we have inflation going back to the Wall Street crash in the US and the UK. And you can see clearly over the last 3 to 4 decades that era of extraordinarily low and calm inflation that's been so good for markets. It's totally historically atypical, however. If you look back in the earlier phases, you had, of course, the 70s inflationary, stagflationary environment. But we think the most interesting one at the moment is the 40s and 50s experience, which we've shaded in green. Here you have very volatile inflation. So you have big spikes and also significant troughs as World War II mobilization disrupted the labor market, much more activist governments used fiscal influence in the economy more liberally, and so on. We think inflation volatility is here to stay. That means don't be surprised if it comes down sharply, but don't think then that the coast is clear. Now, one of the problems we have is that the authorities are completely ill-equipped to navigate this new era. Here we have in green UK realised CPI inflation, and the perforated lines are the Bank of England's central inflation trajectory forecast at every meeting since May 2021. And you'll notice something very mysterious. They all magically end up back at the 2% target level post-haste. Now, we don't think central banks really understand what's going on. Their models are based in the biosphere era of unnatural calm, and now things are breaking down. They're completely unreliable. But it wasn't just central banks that were caught napping, it was investors too. Here you can see 2-year yields in the US, the UK, Germany, and Japan. And this time last year, most people still believed inflation was transitory and there'd be hardly any central bank hikes. Suddenly, Operation Stable Door got underway and caused a massive shock to markets. And for a lot of people, this was the biggest shock of all. Their bonds, which have been for a generation the absolute rock-steady, offset, stable core of the portfolio, have lost a huge amount of money this year. Each line on this graph shows you the performance of a global bond aggregate index each year since Biosphere 2 was completed. The dark line is this year, 2022, and you've lost 20% in your primary risk-free asset, in inverted commas, in many people's portfolios. That's been a real shock. Worse, there's not been anywhere else to hide either, certainly not in conventional assets anyway. If I'd given you perfect foresight over the last 40 years to pick for the quarter ahead the asset class from the list on the slide which would do best, you would have been able to find something that went up in almost every period. And indeed, for the last couple of decades, there's not been a single quarter where out of the major asset classes on that list, everything's made a loss. Until, that is, this year. In the first quarter and the second quarter, there were no ports in the storm in major conventional assets. And that is a canary in the coal mine for what can happen more often as the low rate, low inflation, and low volatility environment goes into reverse. And liquidity is really the key issue at the moment. Assets have loved the era of those factors because they've increased the amount of money that's available to support assets. And here you can see the US 10-year yield declining for multiple decades. But every time the yield tried to pop up above that long-term decline line, you had a financial crisis. Of course, as yields are moving lower, people are taking out more debt. That's making the system more fragile. And that means that smaller and smaller changes in rates can cause bigger and bigger shocks. We've smashed through that long-term decline line now. We think the spigots are being turned off by central banks, and there's likely more liquidation pain to come for markets. The more interesting question is what happens next. Now, liquidation is a big risk and one we're focused on, but the long-term factors shouldn't be forgotten. Here are some of the things we think are driving that more inflation-prone and volatile era going ahead. One is the energy transition. You've got geopolitics, the relentless disruptive forces of technology, the reversal of the greatest demographic dividend in history, more natural risk from the environment, the shift from monetary to fiscal dominance in policy circles, and then issues like inequality becoming much more important. Now, here is Bingham Canyon in Utah. It's 1 kilometer deep. It's a copper mine. In the new era with the energy transition, net zero agenda, you're going to need a lot more metals. And that means moving away from, or at least focusing less on the oil order that's still very much with us. Here we're showing you a map of the world shaded by countries that export a lot of oil versus those that are lightly shaded that import a lot. That's the oil order we've lived in. We're moving into a world where you have to overlay that with metals. And that's going to mean that countries like South Africa, Brazil, Australia, Indonesia look much more interesting and important. That has implications for everything from FX to economic growth rates and sovereign debt. Indeed, commodities generally look quite interesting. You want to own things that governments can't print more of and that the real economy will need. In this chart, we're showing you the relative valuation of stocks to commodities. When the line is low, commodities look inexpensive relative to stocks on a long-run basis. Elsewhere, you need to be focused on what's happening to world order. We've been in an era of ever closer economic integration and globalization. That's been great for corporate profit margins. Here is a map of the contiguous land empires, the year 1700. Random, I hear you say, but the truth is it's the same cast of actors we see in the headlines today. Peter the Great's expansionist empire in Russia, Mughal India, Safavid Persia, that's Iran, Manchu China, Ottoman Turkey in the eastern Mediterranean, European states fighting like ferrets in a sack, and then, of course, new kid on the block, the United States. A multipolar world order will be less stable, and corporates will feel much less comfortable about supply chains going through countries that could turn into enemies. And, of course, ground zero of this is the burgeoning Cold War with China. Now, we've all seen tariffs and tech restrictions and investment restrictions over recent years. A wall is being built between the United States in particular and China, and issues like Taiwan threaten to magnify this sort of disruption worldwide. You need to be much more conscious of political risk in this more volatile environment. And that means focusing on things like lobster pots. These are tempting investments with high returns in more exotic locations, very easy to get into, hard to get out of, as lots of companies that have been heavily invested in Russia have found to their detriment. And this might be one of the biggest stories of all. This is the fertility ratio of China and every other major economic bloc in the world, going back to 1960. You can see that birth rates have plunged precipitously. We are heading for a population bust. That means Western public finance is going to be under monumental pressure. You don't want to be long fiat currency in those circumstances. You probably do want to be long capex beneficiaries around things like robotics and automation, but it is going to make the world more inflation prone. It's also likely to start closing the jaws between these two lines. Here we're showing you share of US national income for the bottom 50% in green and the top 1% in blue. The biosphere era has been great for people who own capital, less good for ordinary wage earners. As the workforces shrink and inflation pressure grows, we think those jaws are likely to come closer together again. But if you don't believe any of those long-term factors matter, I present you this graph as the final one in this section. This is G7 durable goods price inflation going back 40 years. You can see very clearly in the 1990s and the early 2000s the huge disinflationary impact of globalization on prices. But even before COVID hit, even before the supply chain disruptions and all that stimulus got dumped into the veins of the economy, G7 durable goods price inflation was positive again. In other words, the inflation juggernaut has been turning for quite some time. So, the all-important investment implications. Well, the most obvious one is that portfolio structures, entire economic models, company models have been optimized for life in Biosphere 2, that era of falling inflation, falling interest rates, low volatility that we think has been left behind on one bank of the Rubicon. And that matters because it's running headlong into a more inflation-prone and volatile era for all the reasons we've just discussed. It's a particular risk because in the post-GFC era, when rates got to 5,000-year lows, investors didn't just allocate a bit more to risky assets to keep their returns up, they allocated disproportionately more. Here we're showing you risk-free rates on the horizontal axis and mean allocations to risky assets on the vertical. And as rates plumbed those 5,000-year lows, investors allocated disproportionately more to risk assets, and that, of course, can go into reverse as yields rise. Callon Associates here try to give you a flavour of how distorting the years of extreme monetary policy have been. If you wanted to get a 7% return on a forward-looking basis, in 91, the era, the point Biosphere started, you could own almost all of your portfolio in cash. On the eve of the GFC, you could own two-thirds of it nearly in AAA-rated government paper, and the system was still deflationary in nature. On the eve of the Ukraine war, though, you had to lock up a third of your portfolio in liquid assets and most of the rest in very crowded, expensive stocks. That left people holding a lot more risk than they were prepared for and came into this year in a bad way. This is one of the key points of this presentation. Here we're showing you the stock-bond correlation of the United States, and in blue, the dots cover the last 25 years. In green, it's the balance of the years between now and 1960. The key point is that in a low inflation era, central banks have been free to add stimulus supporting bonds when equities have been falling, and that's given you that marvellous offsetting characteristic for a quarter of a century that risk parity and 60-40 and so many other structures have been built around. The key point is that it's unnatural. When there's a bit more inflation in the system, you discover that the stock-bond correlation is positive, and that's an existential risk to the most successful investment strategies of the last generation. So what should you be doing? Well, first of all, you need to be active. Buy and hold in an era of liquidity-fueled momentum trading with low economic growth in the broader economy has been enormously successful. But in a more volatile and inflation-prone era, you're going to want to make use of a much wider range of asset classes, be much more fleet of foot. Don't rely on the strategies that have worked so well for you. So what should you think about doing? Well, here are some of our suggestions. The first is you want to be active. That means don't rely on passive buy and hold in the way that's been so successful over recent years. In shorter cycle, more volatile, inflation-prone environments, you want to be active and make use of as wide a range of asset classes as you can. Part of that is going to be using cash. You obviously don't want to be sitting on that for any long period of time, given the pressures on fiat currency, but it will give you optionality and it will make you anti-fragile. You're not going to be forced out of positions that you don't want to be forced out of. Instead, you're going to be able to make the most of the opportunities that arise. We also use derivatives because we think that as rates, inflation and volatility all increase, that's pressure on all conventional asset classes. We want to make sure we can always protect and grow in any market conditions, so we use derivatives to do that. That will also help you make time your friend. Again, don't be panicked out of things. So finally, how are we positioned ourselves at today's date? Well, here's our asset allocation on the left-hand side. It's primarily a mix of inflation-protected bonds. Nominal bonds also now look much more interesting given the high yields on offer. And further out on the curve, the symmetry to us looks much more favourable, even if short-term rates are going to move higher as central bank hiking is not yet over. We've also got a bit of exposure to gold, a historically low weighting to equity because we think you can take risk more attractively in the fixed income component at the moment. But we've got a significant allocation to derivatives because for the reasons mentioned previously, you don't want to rely exclusively on conventional assets. So we have positions that profit from falling credit markets, falling equity markets, rising Japanese yields, and so on. So we think the world ahead is more inflation prone and more volatile. We've set our portfolio up to address that. It's also hopefully in a state that will protect and grow capital, even if what I've set out today is completely wrong. Ruffer builds portfolios for all market conditions. But I hope I've given you a sense of why crossing the Rubicon to a more inflation-prone and volatile era is a real challenge for the most popular strategies of the last generation and what you might think about doing to address it. Thanks very much.
Thank you, Alex. Next up, another incredibly timely session. The tech sector has taken something of a beating over the past year, and in the last couple of weeks, a number of huge names have announced cost-cutting job cuts. Asking the extremely relevant question, what's next for tech? Ladies and gentlemen, please welcome Ben Rogoff, manager of the Polar Capital Technology Trust.
Hi, I'm Ben Rogoff, and I'm one of the partners at Polar Capital Technology. Today I'd like to give you an update on all things tech, and I'll start with our team, which remains one of the largest dedicated technology teams in the UK and Europe, as well as the wider world. And today we run 3 portfolios with more than $7 billion in assets, focusing exclusively on technology and tech disruption. Our investment process remains a combination of top-down and bottom-up, by which I mean the identification of key themes that we believe will be critical to gain exposure to over the coming years, trying to identify the best ways to gain exposure to those themes, avoiding companies that we believe to be on the wrong side of change or in value incumbents, and then building a portfolio around those themes and stocks, with an eye to the benchmark, particularly as it relates to some of the most important assets. And unique to tech, being very careful about selling stocks that don't necessarily meet our expectations or where an investment theme has changed or timeline has changed. We are strong believers in the fact that there remain an incredible plethora of interesting ideas within tech, and we're very careful not to overstay our welcome where themes or companies disappoint. We focus very heavily on penetration of themes and the inflection of those themes. This chart here hopefully demonstrates we are really focused on the areas where penetration has already reached 5% and is still below 30% penetration. That's, in our opinion, where the most exciting change occurs. It's when change often goes from being something that's linear to being non-linear. And so we focus heavily here on themes that are in those penetration ranges. Often companies end up looking more expensive than the average because our experience is, at least, that the successful ones there will end up delivering much more revenue and earnings growth than the market currently expects. In contrast, we try and stay away from companies at the end of their corporate life cycles. Typically, these are some of the more attractively valued companies on things like PE and cash flow, but our experience is that they are slightly tricky places to invest, where companies often use M&A and financial engineering to create the facade of growth, but really are experiencing terminal growth rates that are negative. Likewise, we try and stay away from very early stage investing. We think public markets do a pretty poor job of pricing early stage binary risk. And so we do lots of work on themes that are early, but we try and stay away from companies that still need capital to make it, preferring, again, as I say, to wait for themes to reach that critical inflection point. Now, the pandemic was a good period for technology companies. Beyond any experience really in my life, it demonstrated how the criticality of my sector kept the world spinning, while biotech and AI found vaccines that thankfully have sort of severed that link between COVID cases and deaths. But the tech sector enjoyed more than just a good pandemic. It enjoyed a fantastic post-Great Financial Crisis period, really, where the smartphone, the internet, and a whole plethora of applications that sat on top of that conduit for change really came about and reinvented industries. And so created some very big companies by redistributing profit pools that might have been captured by traditional industries. The last 18 months, or certainly since the Fed pivot a year ago, has been a trickier backdrop for tech as well as other growth stocks. And we'll talk a bit about that over the next few slides. As I'm sure you're aware, the investment backdrop became much trickier when the US Federal Reserve admitted, I guess, that they'd been wrong to hope that higher inflation would prove transitory. And since then, we've seen really one of the most dramatic synchronized tightening cycles really in anyone alive in the investment world has seen today. It's been a very difficult market to have escaped. The tightening of financial conditions, has been very, very dramatic. We've seen real rates go from being negative to being sharply positive in a very short space of time. Not an easy environment, as I say, for companies that are valued using discount rates. Very difficult for companies that were caught up in some of the earlier exuberance of a long and late bull market. But there's still hope here. We try and show on this slide that while there are significant upside and downside risks, and while we cannot know what the path of inflation takes over the coming years, given the uniqueness of this investment backdrop that we find ourselves in, we're sort of cautiously optimistic that the tighter conditions that we see today will, with a lag, manifest in the form of lower inflation. If that's true, then there's the possibility that we're looking at right now at sort of peak inflation, peak Fed. And that hope feeds into a reasonably optimistic outlook for 2023. Finally, though, on the macro, it's worth pointing out that the impact of higher risk-free rates has obviously weighed on multiples in the broader market. We show that here on the left-hand slide when we compare risk-free rates with the S&P PE. It's been even more profound, the impact of risk-free rates, that is, on the valuations of next-generation companies. And we show here the forward EV sales multiple of an aggregate of cloud software companies. And as you can see, this past year or so has been extremely painful, as we've seen very significant valuation compression, taking that group of stocks to levels that we haven't seen for quite a while. In terms of the immediate outlook for tech, clearly our IT budgets are susceptible to ups and downs of the macro cycle, and we've certainly seen that over the last 6 months. So here we show what the current expectations are for IT budget growth. We think that these are not unreasonable expectations as things stand today, but again, the range of potential outcomes as we make our way through the remainder of this year and next is unusually wide. Tech stocks against this backdrop should still be able to deliver decent growth if unexceptional growth, against a sort of more inflationary backdrop, and where, of course, energy prices and energy sector are delivering very strong returns. But we're heartened by the fact that IT budgets continue to be focused and favour the themes that we're excited about, because in the end, they're the themes that allow companies to deliver digital transformations or return on investment. The portfolios that we manage are built around core themes, and here we show 6 of them. I don't have time to run you through them all. You may be relieved to hear that. But the key point here is that this is a diversified approach, not a single theme. We're not just investing in electric vehicles or just investing in alternative energy. We try to capture the most important themes as we see them within one product. It's a diversified approach. And as you can see here, some of our largest themes, but the belief and hope is that we are able to not just identify those themes, but also be able to allocate to where we see the best risk reward within those themes. And hopefully, it's quite a busy slide, but hopefully you can see here that we've been reducing, for example, our exposure to the consumer, e-commerce and advertising markets against the backdrop of squeezed incomes and weakening consumption trends. And we've been putting money instead into areas that we believe will be slightly more evergreen, like cyber security, and this green line at the bottom, moving money towards things like solar inverters and electric vehicles that we believe also have very strong tailwinds, even against a more difficult macro environment. We're also excited about a plethora of emerging themes. I haven't got an awful lot of time to talk about these, but you can see a few listed here. Certainly AI is the most exciting as we see it. The ability to take data, crunch it, and then extract value that wasn't apparent before is a fairly profound thing. And today, really, we're only scratching the surface. Companies, the world only really uses 1% of the data that we capture. AI is really the first class of technologies that will allow companies to analyze unstructured, that's data that it's very hard to provide schema for, to be able to analyze that massive data in order to make better decisions. And I think we're seeing some very exciting use cases there playing out already, but we're really at the beginning of a very exciting multi-decade process. Very excited about technology's role in reinventing transportation. The success of electric vehicle makers like Tesla, but BYD in China, I think is proof of that. But we're also excited about our role in helping to address the critical challenge of energy security. We don't get involved in the nuts and bolts, if you like, of alternative energy, but we will hopefully be able to identify technology ways to gain exposure to that exciting theme. Here we highlight a few companies like Enphase Energy and SolarEdge. Both are in the battery stroke inverter market. Longer term, the metaverse, now probably lampooned, but nonetheless, the pandemic taught us nothing if it didn't tell us that we can be together and apart at the same time. And Mark Zuckerberg's vision for the metaverse, I think, may still be a long way away, but the idea that ultimately this is an enormous market opportunity with the potential to redistribute masses of profit pools, I think remains. But we're slightly guarded about the timeline for the metaverse and have very minimal exposure in that emerging theme today. Quickly on valuations. Clearly, we're in a derating period. We've talked about that already, but we're heartened by the fact that the tech sector today looks nothing like it did in aggregate, at least, with the late 90s. And at that earlier time, it's where I did a lot of my learning on the buy side, the tech sector really was the only thing that mattered. And that's why it got to a valuation level that you can see here was very extreme. Tech stocks traded more than twice the market multiple at that time, and the earnings that that valuation was built on were very heavily linked to people's capital spending budgets. Today, the tech sector, yes, it had a good run through the decade, but it really did that driven by its earnings progress. And you can see that here because the tech sector's relative PE didn't get any higher than 1.4 times the multiple and is today back at 1.1 or thereabouts the market multiple. This is a sector, of course, that has the best balance sheets of any US sector. And so once you adjust for that, we're not trading far off a market multiple. We've talked a little bit about valuation compression, but here you can see it. These are some groups within my world, next generation assets in the internet, and on the right-hand side, the software space, the valuation compression has been very significant. So we know that there must be downside risk to tech earnings as we think about the weaker macro environment next year and, of course, tighter financial conditions. But we're heartened again by the idea of just how far valuations have already compressed. And just as you can see from the slides, but also just the idea that the average software stock today is trading well below where the average stood between 2010 and 2020 says that at least some of the weakness that's coming must be priced in. And here, I think the most important slide probably in our deck is the convergence of next generation valuations with incumbents. Again, pretty rare to see that happen almost always when people are worrying about markets and macro and risk. Understandable, because as I said before, the range of outcomes looks as wide as we've seen for a while. But the last time we saw this convergence was in 2015-16. And once the macro conditions had improved, the narrative was able to be rebuilt. And it turned out to be a pretty good time to have been invested in tech. This is the portfolio. Please feel free to visit our website to get more information about what the portfolio looks like today. But I think the most important punchlines are that we assemble a diversified portfolio that we hope is relatively underrepresented in the index. And against that, we will take some very large, if not zero, positions in what we believe are incumbents or companies that have had the best of their growth. And you put that all together, and right now at least, you end up with a portfolio that trades at a relatively modest premium to the index on an EV sales basis, but is set to, according to the forecast today, deliver meaningfully more growth than the index. I hope that was useful. Thanks so much for your time.
Thank you, Ben. Now, I have to say, I've never in my 20 plus years of broadcasting been asked so often about bond markets as I have been this year. Talking us through why she believes fixed income markets are setting up for compelling returns and explaining how her team looks to take advantage of market opportunities with a session entitled Back to Bonds. Please welcome Rebecca Young, Fund Manager at Artemis.
Hi, my name is Rebecca Young, co-manager of the Artemis Strategic Bond Fund. Now, there are a number of reasons to be optimistic as bond managers, and I'll take you through this presentation as we touch on some of those key reasons why the outlook for bonds is more positive going forwards. As bond managers, we've waited many years for competitive income to return to our asset class. A world of QE, suppressed yields, and triggered a reach for yield trade in fixed income markets that's now currently unwinding as central banks retrace. And importantly, it's an environment where we don't need to take an aggressive amount of credit risk or interest rate risk to arrive at an attractive all-in yield. And we'll start today with the macro backdrop. Inflation forecasters have had a difficult time of late, to say the least, and those, even at the Fed, continue to acknowledge that there's a high level of uncertainty around their inflation forecasts. Here we have a scale between 0 and 1, with 1 referencing highly uncertain. And the Bank of England have been chasing their tail, revising up their inflation forecast time after time. And these are very well qualified, highly experienced central bankers. So it'd be foolish for us to say that we can do a far better job sitting here today. But it is important to acknowledge that there still is that high level of uncertainty about inflation that's still real and that is yet to dissipate. And those inflationary pressures of this cycle differentiate this cycle to recent prior cycles. And as investors, we've all had to think a little bit differently this time around because of that inflationary backdrop. Major developed market central banks around the world are moving to forcefully and urgently raise interest rates, as they should, with the idea that it will be increasingly costly if they were to leave it later and wait down the road for that inflation fight. And there are reasons to believe that it will take time for inflation to normalise to levels that we're much more accustomed to. There are trends such as deglobalisation that may mean that actually when we do see inflation fall, that we will fall to a level that's structurally higher than what we were used to during the pre-COVID era. Now, that backdrop has set up for a difficult backdrop for bond investing. And returns in 2022 have been very difficult. Actually, if we look back to the 1970s, difficult may well be an understatement. Returns have been dramatic. But fast forwarding and starting with today in terms of where we are, and this is a sensible starting point when we look at fixed income markets and we look forward. If we look to UK interest rate expectations as priced into the market currently, we've been on quite a journey in terms of that repricing and reassessment by the markets as to what needs to be done with UK interest rates for the Bank of England to successfully fight those inflationary pressures, but also balance what is the UK economy is likely to be able to absorb. So we think these levels that we're at the moment, yes, we're at lower levels than we were during and around the time of the mini statement, but actually these levels to us seem like a much more reasonable starting point. And importantly, as we look across our different fixed income asset classes, this is a very unusual time because there is competitive income available across the different asset classes that we invest in. So whether we look to gilts, whether we look to investment grade credit, or whether we go to the high yield market and really focus on the higher quality parts of the high yield market, so double B rated credit, actually there is a real wealth of yield and income available right now. And it's not an environment where we need to dip down to very low quality credit or buy very long dated bonds to achieve an attractive all-in yield. The Artemis Strategic Bond Fund is running with a quality tilt to our credit allocation. So our largest allocation in credit is in investment grade space. We've been moderating our high yield allocation over the course of this year. And where we do retain exposure, it's smaller and it's predominantly concentrated in just the double B part of the market predominantly. And in government space, we've been building an allocation after coming into the start of the year particularly cautious on government bonds. The headline duration of the fund is 5 years, and that really comes together to result in a yield to worst for the fund of around 6.5%. And there are reasons to be optimistic about future returns from here from fixed income markets. If, for example, here we take the Bloomberg US Ag, which is a very high quality investment grade focused index. It's a broad-based fixed income index, and we have data back to the 1970s. If we look at the relationship between starting yields and forward returns, it tends to be a very strong relationship. And actually at today's starting yields, this would indicate that we're setting up for healthy returns over the coming years. And importantly, the all-in yields in the market now stack up well versus the likely profile for inflation in the UK. By no means are we inflation forecasters, but if we look at what the market is implying in terms of 1 year inflation rates in the UK, locking in multi-year yields at today's fixed income valuations is setting up for solid returns over the medium term, but also returns that look set to outstrip inflation over the coming years. Now, in terms of credit spread compensation, and we talked a little bit about having a focus on the investment grade space at the moment, broadly speaking, the market valuations are supporting those investors that want to upgrade the average credit quality of their portfolios. Here we look at the relative credit spread compensation between investment grade credit and high yield credit. So really, what multiple of investment grade credit are we getting paid to take high yield risks today? And actually that's quite low. So we've been focusing our time more on the investment grade space, and this is where a lot of the issuance has come this year. Against a difficult market backdrop, these are generally large, resilient businesses that have ongoing access to corporate bond markets. So if they need to issue for refinancing needs, or they need to issue for M&A, for example, they have that continued access to markets. But given that more difficult market backdrop, actually the yields and the all-in coupons that a lot of these bonds have been printing with have been attractive for us to lock in. So we've been participating in those deals. And they're businesses that are household names, so deals that we've participated in the past few months would include names like McDonald's, Pepsi, Nestle, for example. In the government space, this was a space we came into the year particularly cautious. We had conviction that it was one of the most expensive places for fixed income in terms of valuations that were in government bond markets. And we've had a dramatic reset in valuations. Over the course of this year, we've been building our allocation in the government bond part of the portfolio. And it's not valuations looking attractive across the board, it is in specific geographies. And the more global nature of the fund means that we can look for opportunities in other markets outside the UK. And an area that has been interesting of late has been in inflation-linked bonds, for example, in the US and New Zealand here. And it's really that ability to be able to source positive real yields, which has not been the case for a long time. And we firmly believe that on a medium-term basis, having an allocation to government bonds here provides for a complement to where we have credit exposure in the portfolio more broadly. But those inflationary pressures of this cycle do mean that this environment is a little bit different, and we do think that has a number of implications for fixed income investors. We're moving from a world of QE, where frankly it was an environment of lots of liquidity, where it was hard to differentiate between good stock selection skills and poor stock selection skills because everything went up together. Now today we're seeing a rising level of dispersion. So the valuations within fixed income markets are broadening out. We're seeing fewer and fewer bonds trade at or close to the index level valuation. So when we do have credit positive or credit negative news, we are seeing bonds move quite meaningfully in the market. And we've seen that dispersion tick up in the high yield market this year. That's a marked change. And here we have the investment grade market, where you can see that over time, over the QE era, dispersion trended down lower, but very recently we started to see dispersion tick up, and it's our expectation that that trend will continue. Ultimately, we think that's an opportunity for active managers, especially those with stock selection as one of the key inputs into their process. Now, implementing those stock selection views is not easy with the backdrop of liquidity in fixed income markets. And in a post-QE regime, we wouldn't expect this liquidity picture to improve from here. Here we have the US investment grade credit markets, the daily trading volumes as a percentage of the market outstanding. As you can see, they've trended down over the past couple of years. And remarkably, 85% of these trading volumes are concentrated in just 20% of the bonds outstanding. So those trading volumes are low, and they're also concentrated in just a number of bonds. We would argue that going forwards, very large funds are going to find it increasingly difficult to do stock selection well in an environment where stock selection really matters again. We believe it's crucial to have access to the full spectrum of fixed income assets, and that has been important, very important, especially over the last year. What we're trying to do at Artemis is asset allocate between the different fixed income markets, looking for the best opportunity set that exists at any point in the economic cycle, in one product, actively managed. The core of what we do is in cash fixed income markets. That will be the key and is the key risk return profile for the fund, or risk return driver for the fund. We do have access to derivative space, both in credit markets and in government, in rates markets. And what we do in derivative space is more of a complement to what we do in the core of the portfolio in cash fixed income. But really having access to both allows us to have the ability to diversify those sources of risk and return. We're very well supported by the wider fixed income team at Artemis, which is structured as an experienced team of fixed income investors, really across the core ingredients of a strategic bond fund, so investment grade credit, high yield credit, and government bonds. And very consistent with the wider and other funds that sit on the desk within the Artemis fixed income franchise, this is a dynamic product, and we run it in a focused manner. And over the last year, it has been important to have that flexibility, that ability to position the fund across those different fixed income asset classes, and really having that full toolbox and flexibility has allowed us to position with quite a cautious positioning with respect to interest rate sensitivity and with respect to credit risk over the course of this year. And that has helped at the margin in what has been a very difficult market to focus on capital preservation where we can. This is the wider investable universe that we have access to in terms of how we put the portfolio together. In summary, we've had a dramatic reset in valuations in fixed income markets. This is actually a time where we can be quite optimistic about the future returns in fixed income. In terms of interest rate expectations, we're now at a much more sensible starting point. Income has returned to our asset class. And this is an environment where we don't need to stretch down to the lower quality parts of the credit markets, or we don't have to buy very long dated bonds. This is really an environment where there's lots of yield available, so we can choose that selectively. But we do think there are a number of implications about transitioning to a post-QE world, the likes of, for example, an importance to focus on stock selection and also to remain nimble, to be able to effectively navigate the new regime.
Thank you, Rebecca. Now, up next with his session titled Sustaining Positive Change for Another 2 Decades is Peter Michaelis, Head of Sustainable Investment at Liontrust. The need for sustainability has only been enhanced by the current global crises, and in this presentation, Peter Michaelis will explain why the long-term investment case for sustainable companies remains as strong as it ever has been over the past 2 decades, and why the sustainable themes and quality of the businesses that benefit from them as they solve critical sustainability challenges gives him confidence for the future. Ladies and gentlemen, Peter Michaelis.
Hello everyone, I'm Peter Michaelis. I'm the Head of Sustainable Investment at Liontrust. Over the next few minutes, I'm going to talk about the performance the strategies have experienced in 2022, the action we've been taking around the portfolio, contributors, detractors, but most importantly, I'm going to talk about why we have such confidence in the strategy in the future due to the strength of the investment themes that we're backing and the quality of the businesses that we're invested in as they solve critical sustainability challenges. The aim of the Sustainable Future Funds has always been to deliver superior returns by investing in sustainable companies. We also use our ownership of businesses to engage with those businesses in order to deliver so that they can improve the way that they operate and to deliver a positive impact in terms of improvements in society and the environment. Now, why do we believe this strategy works? Well, really, we think that the market tends to underestimate the strong growth that is linked to our sustainable investment themes, which you can see here, the 20 sustainable investment themes grouped into 3 categories of cleaner, healthier, and safer. And so sustainable businesses experience stronger growth because they are aligned with these themes. And you can see themes around, ones you're probably very familiar with, around renewable energy, energy efficiency, healthcare, sort of financing the transition to a low carbon economy and digital security. All of these are areas of the economy that we expect to have strong growth, while businesses aligned to them will deliver a positive outcome for people and the planet. Now, one legitimate question that investors might be asking themselves, having seen a year of poor performance so far this year, is have these themes in any way run out? We think the answer to that is emphatically no. And let's just look at a few examples of this. So firstly, carbon dioxide emissions are continuing their relentless rise. And you can see that here, and that has an impact on global temperatures, and we'll see that in a later slide. Now, stopping this trend is going to require the replacement of 80% of our energy system, which currently depends on fossil fuels. We think that's an enormous market opportunity for renewables, energy storage, and energy efficiency, all of which will back that theme. And very interestingly, recently we've seen amazing policy moves, in particular in the US, where the Inflation Reduction Act has come in with the aim actually of making the US a leader in the production and installation of renewable technologies. And that's $370 billion worth of funding. So we think there are very positive ongoing trends as we solve the sort of greenhouse gas emission problem that we're facing with the current energy system. Let's look at one other area, which is how we use materials. Now, this is plastic packaging, but it actually stands for a lot of the materials that we use in our economies. Every year, we spend enormous amounts of energy and resource and effort making 78 million tons of plastic packaging. And it's an incredible material. It's lightweight, it's hygienic, it's waterproof. And then, once we've used it, only 14%, 14%, gets recovered and recycled. This is absolutely crazy in terms of resource efficiency, and it also has a terrible impact on biodiversity within our oceans and on land. Now, companies that can take advantage of that resource inefficiency, we believe, will succeed in the future. So, making our economies more circular. And then we turn to health. In the UK, this is just an example in the UK of how diabetes has increased, with there now being 4 million people with diabetes. And this has doubled over the last 15 years. So while we've been pretty successful as a species in treating communicable diseases, obviously COVID has illustrated some of our vulnerabilities remain there, we haven't been very good at these sort of non-communicable diseases. But we believe we're on a cusp in terms of innovation in health, of finding ways to better diagnose diseases earlier and also to treat them using breakthrough gene therapy treatments. Companies which are involved in the research, development and production of these treatments, we think, have a very strong future, and that fits within our innovation in health theme. So in short, we believe the sustainable investment themes that we're backing have a very long way to run. But as a team, we don't just go out and buy companies which are linked to these themes. We do want those businesses linked to the themes to have more than 50% of their revenues coming from their theme, so it is a major driver of the growth, but it's not enough. There are 3 other stages which are absolutely critical if we're going to find investments which are going to deliver strong returns for our clients. The first is we look more deeply in at the sustainability of that business. So not only what does it produce, but also how does it operate? How does it incentivize and treat its employees? How does it relate to its suppliers, and how happy are its customers? What's its governance? What's its energy use? All of these factors, we believe, are very good indicators of how well a business is being managed. And we only select those with superior management of these aspects. The third stage around business fundamentals is so important when you're thinking about growth companies, because we want businesses that can grow without having to put loads more capital to work, and so that their returns don't diminish. We want businesses that their returns actually increase, or at least are stable as they are seeing this growth, and we call that strong business fundamentals. And the final stage is about valuation. Now, this is where we look forward 5 years to say, what do we believe this business can generate in 5 years, given our assumptions about the strength of the business and the growth it's going to achieve and the returns it'll also generate. On that basis, we then work backwards to today, and if we can see from today's share price a 10% return per annum, then that is a stock which we feel able to buy for the sustainable future strategies. So this 4-stage process underpins every single stock that we look at. Now, in 2022, we've been experiencing, there's a lot of volatility in share prices, and I'll just use an example of a company that we have recently added to the portfolio as an example of how this process works in practice. And the company is Vestas, Now, Vestas may be familiar to a lot of you. It's the leading wind turbine manufacturer in the world. It has a leading position in terms of turbine design, blade design. It's got a global supply chain. It's got a great installed base. It has a great service and warranties business as well. So it's doing very well. But the reason why we haven't been invested in Vestas until now, or not for many, many years, is because we had a problem with its business fundamentals. In short, as the price of wind turbines continued to fall, they were finding it very hard to make strong returns. Now, following meetings with the company and a lot of our own analysis and discussion with experts in the field, we believe that the company has turned a corner in terms of its ability to generate profitable growth in the coming years. The other factor that has changed is that the share price has fallen dramatically since its highs in 2021, meaning that there is now that valuation support. So here we go, the 1, 2, 3, 4 for Vestas are all working, and that means that we can add it to our portfolios. Currently, it's a 1% position in our global strategies and European strategies, and as we get more assurance that the company is doing what we believe it will do, we can add to that position. So Vestas is one example of what we've been doing on the strategies to sort of take opportunities from the sell-off in some of these stocks. And I'll name a couple of others which we've added to our global portfolio here. And the first is Agilent. Agilent is a company which does chemical testing of water, food, medicines, air. If you want to know what's inside something, you're highly likely to use an Agilent product. A lot of consumables. We think it's a great business. The shares had fallen by around about 30%, and we've been watching it for a long time, and we felt that this was the opportunity to add a position into our portfolios, and it's a 2% position within our global strategies. The other company I'll briefly mention is Advanced Drainage Solutions, because it makes plastic pipes for water management, which with climate change is going to be an increasing issue around the world. It's in the US. Why we think it's interesting is because it uses as its raw materials recycled plastic. So going back to that chart earlier, it uses 30%, almost 30% of all the plastic bottles which are recycled in the US. So a good example of that. And in terms of funding these purchases, we've sold out of businesses where we had less conviction in their business fundamentals. So Prudential with its political risk in Hong Kong and China, for instance. Now, how is the portfolio positioned today, and why do we have confidence in the future? Clearly, 2022 has been a very difficult year for growth stocks. As interest rates have risen, so growth stocks have seen their valuations fall. We feel that a lot of that has been indiscriminate, and that as the years progress and we get into next year and the year after, there'll be much more discernment in markets about which businesses will actually be able to grow and which won't. But you can see here from the contributors and detractors that the detractors were companies like Spotify and like DocuSign, which are growing into very large addressable markets, but most of their profitability is in future years. And for that reason, they've fallen a long way. Equally, those which have contributed well have been those companies which are maybe a little lower in terms of their growth trajectory, but are producing lots of cash and returns today and in next year. It's much more certain. So companies like Compass Group or London Stock Exchange, for instance. So that's what has driven poor performance within the equity funds. In the corporate bond world as well, we've seen as rates have risen, the corporate bonds have suffered dramatically too. And that's also been an issue within our multi-asset funds in terms of longer-term performance. But we don't believe the future is going to be just like 2022. And if we look at the portfolio, it's positioned diversified across themes, as we'd expect, with 18 of the 20 themes represented here. That gives us diversification across the economy, albeit we have this bias towards growth. So that's still intact, and that's a position which has served us well over the 20 years that we've been running these strategies. If we look, though, at the portfolio as a whole in aggregate and compare it with the MSCI World, as it stands today, the portfolio, we believe, is very attractively positioned with stronger sales growth, stronger earnings growth, high gross margins, which indicates that the companies we're invested in have strong pricing power. And also, if you look at financial leverage, in aggregate, from our global equity strategy, we are net cash versus the benchmark. So all of those point to high quality, high growth companies. And then most interestingly, if we look at the valuation, so here using price to free cash flow, the premium you're paying to the market for these positive characteristics is actually very low compared to history. In fact, the last time it was like this was back in 2018, when the growth prospects were about 50% lower than they are today. So we think this is a positive indicator of how the portfolio is positioned today. Equally, I think it's important to look at the performance we've seen this year, which has, I'm not trying to sugarcoat it, been a poor year in terms of performance. But if you look at that in the context of longer term returns, we can see that this is, again, for the global growth strategy, over 3 years it's in line, over 5 years and 10 years. It's delivering that strong outperformance that really we said at the beginning we're trying to achieve for our clients. And when we've had periods of poor performance in the past, subsequent years have shown much stronger return. If we then look to the other aspect of how the Sustainable Future Funds run, how we engage with businesses to improve their practices and also get them to deliver a more positive impact on behalf of people and planet, we look to engage with companies around several proactive engagement strategies, and you can see them listed here. And I'll just briefly talk about one, which is around climate change and encouraging that transition to a low-carbon economy. Now, there's a fantastic graphic which I'd encourage you to visit, which is a sort of animation, but basically it shows what has been happening to global temperatures over the last 150 years. And it leaves you in no doubt that we are in a position where we're in a world which has warmed over 1.2 degrees since pre-industrial times. We do have to solve that. We are confident that we will solve that as a species. What it means for investors, though, is that there's this additional risk in being in high carbon, high emitting companies as they transition. And our portfolio, just as an indicator of impact, is much lower in terms of its carbon exposure, so 89% less operational carbon emitted than if you were invested in the benchmark. 27% of the portfolio is in low carbon companies, help companies accelerate that move to a low carbon future. And we have zero exposure to the fossil fuel companies, so coal, oil and gas. And we're engaging with businesses that we own in order to get them to accelerate their transition to a low carbon future. So I'll sum up by saying that yes, 2022 has been a disappointing year for performance for the sustainable future strategies that we run. We have, over our 20 years, seen previous times where the funds have underperformed, and subsequent performance has been much stronger. And we believe that is due to the strength of our investment themes and the quality of the businesses that we're invested in as they solve critical sustainability challenges. Thank you very much.
Thank you, Peter. I'm pleased to welcome our penultimate speaker to your screen. With volatility the word du jour and recessions seeming inevitable, the tables are turning. After years when low interest rates favoured the growth stock, it might just be time to plump for a bit of jam today and take another look at value investing. Giving us the case for a value approach in UK equities, we're delighted to welcome Alex Wright, Fund Manager at Fidelity.
Hi, I'm Alex Wright, the lead manager of the Fidelity Special Situations Fund and the Fidelity Special Values Investment Trust. I'm here today to talk about the case for UK equities and particularly about why a value approach makes sense within the UK market. So there's a lot of negative headlines out there today, both on a global basis and then also talking about the UK in a negative light. But I think the big difference to some of the crises we've seen over the last 10 to 15 years is actually the part of the market that's being badly hit is the growth investing part of the market, because this downturn is very much about the cost of capital rising and the amount of free money being available being restricted. And I think that's a really good setup in terms of the potential for value to outperform from here. You can see that those negative headlines have really generated very negative sentiment. So it is right that there's a lot of geopolitical risks, a lot of economic risks out there, both in the UK and across the world. But those are very well reflected by investors. So indeed, if you look at fund manager surveys, here on the left-hand side, that the sentiment around growth is actually worse than we saw before the financial crisis. So an incredible negative one-sided consensus in terms of the outlook for growth. And then if you come home closer to the UK in terms of the UK consumer, you can see that the consumer confidence index has actually reached an all-time low in the middle of 2022, even lower than we had during COVID and even lower than during the financial crisis when there were mass layoffs, higher unemployment, etc. So unprecedentedly negative pessimism against the market. So yes, the outlook for the economy is worse, but that is very much reflected by consumers and investors, and therefore that's setting up good valuation opportunities. Indeed, this is the key slide for me in terms of why it's such an exciting time to be investing in the UK. It's about the price you're paying for assets, which is really low, not just versus other asset classes, but versus the UK's own history. So here we've got the world's major equity markets, with the US, the biggest market, at the top, and the UK and Italy right down at the bottom in terms of valuations. So the UK market, not only cheap absolutely, on about 9 to 10 times earnings, but well below the 10-year averages in those blue bars. Whereas the US is the world's most expensive market and is even expensive versus its own history, again shown by those blue bars. And it wasn't always this way. If you look at the left-hand side, you can actually see the UK market traded very much in line with the EU over history, but has derated to about a 15% discount, and then generally traded at a 10 to 15% discount to the US previously, but now is at a 45% discount. So this is why I think the UK is an attractive place to invest today, particularly on a relative basis. So I think as the largest asset market globally, investors generally have a very large percent of their assets invested in global and US equities. And I think today that is probably a mistake in terms of sort of future performance potential. If you look at some more sentiment indicators, again, why could now be a good time to invest? It's because everyone's already very bearish. So you want to be investing against the consensus. I'm very much a contrarian investor and like to see it when people are negative. And then an area of the market that people are particularly negative on today is the mid and small cap part of the market in the UK. So quite unusually for a downturn, the market as a whole in the UK is pretty flat over the last 12 months. So a decent performance for investors compared to other asset markets. But mid and small caps are down about 20%. So I think it's particularly here that you're seeing some opportunities today, particularly where you see some forced sellers. So what we're showing here is the outflows from UK small cap funds. Basically what this creates is forced sellers. If people are taking their money out of open-ended funds, this means that those funds need to sell their underlying investments, and because that's happening across the market, that there's a lack of buyers and therefore prices are adjusting downwards. And this is something we're really taking advantage of. A forced seller is always a good seller to buy from. You want to have the liquidity in your funds to be able to take advantage of that. And particularly in the investment trust, special values, its closed-end nature, its ability to gear, that's something we've really got the opportunity to do. So compared to some of our rivals that are having to sell because they're forced to by their investors, we can actually be the other side of that trade, which is a really exciting place to be. We then sort of talk about actually what's been driving some of the market downturns, particularly in bond markets and in higher growth stocks. It's the big change in the cost of capital. So interest rates were at rock bottom levels, sort of touching 1% in 2020. And those have very much moved back into the 3.5–4% range. So the cost of capital has moved up a lot. But actually, it's not really an unusual cost of capital compared to history. It's much more in the long-term range. It's just the last 10–15 years we've been outside that range. So I think there's still a lot of waking up to do in terms of actually what this means for companies, particularly some of the growth companies that may have not been around 10 or 15 years ago. They haven't really dealt with an environment like this. And so I think you need to be quite wary of newer companies, growth companies. You want to stick with more established old world companies that have been around, that know how to deal with a positive cost of capital environment and are well financed. And that's very much where we're looking for investments. This next slide is probably the second most interesting one after that valuation point, is just how uncongested the space is, how little competition there is for the type of stocks that I'm looking for. So this shows how much money is invested in the all companies space from UK investors. There's been a dramatic growth. It's been a very good 10 years for investors in asset markets, and you can see the growth of funds. But then you look at how much of that has gone ex-UK, it's the vast majority of it, and then how much of that has come out of value and gone into growth. So it's always been contrarian to be a value manager. Even 10 years ago, it was only 2.5% of the investable universe went into UK value funds. Today, it's sub 1%. So why is that attractive to me? Well, if you think about it, what are those growth managers, what are those global managers trying to do? They're trying to compete with dozens, if not hundreds of other investors to get an edge in a high growth, large market cap company. And if you're competing with that many people, it's going to be really difficult to get a stock specific edge. If you're looking at a smaller company, a company in an unloved market, with maybe only 5 or 10 other investors, the chance you can get an edge is that much higher. So your ability to add idiosyncratic alpha over and above the asset class is that much higher in this area. And I think that's not just something we've been able to do over the last 10 years, but it's something that this opportunity set is actually increasing the ability to do going forward. And so it's a really exciting aspect of the market today. If we then have a look at how I'm positioned in the funds and where are the most opportunities sector-wise, I'd say financials is a really interesting sector. It's a complicated sector that people have really shied away from post the global financial crisis, but where companies actually are dramatically changed compared to the past, much stronger balance sheets, much more resilient business models, but yet an area people aren't really looking at. And the key positions that we have here are in the banks and the life insurers. If we have a bit more of an in-depth look at the biggest of those positions, so the 15% we have in banks, the 4 biggest names that we're invested in are NatWest, AIB, Barclays and Close Brothers. And I think this is a very differentiated position compared to other UK funds. So I think you don't just want to invest in an unloved market, you actually need to invest in some of the unloved names. And I think banks for me is the key area and we're a key differentiator. So we've actually had a look on the left-hand side at the 3 biggest funds in the UK with special situations, the open-ended fund being the 4th biggest fund in the UK space. Banks are about 10% of the UK index. But interestingly, those 3 funds, so the biggest AUMs in the UK, they basically don't own any banks. And now to me, that is really surprising because banks are seeing earnings upgrades, so roughly a doubling of earnings expectations for 2023 for NatWest and for AIB over the last 12 months. And these stocks have been performing well. So again, some of the biggest contributors. And so I think people are just overlooking this because they've got so used to looking at the same sort of things, that the safe growth companies in staples or in technology that makes up the bulk of those portfolios, and shying away from these more complicated areas in banks that have had a really tough time while interest rates are low. The difference is interest rates aren't low anymore. These banks are starting to earn money in terms of net interest margins on their zero cost current account deposits. That's something that was always a key part of the business model of banks, which has really not been possible over the last 10 years. So a real seismic change here that I think investors have actually totally missed in many cases, and therefore still a strong opportunity from here. So to sum up, I think we really do have to bear in mind that it is an uncertain macro and geopolitical outlook, and that is the case globally, not just in the UK. But actually this type of environment where people are scared, people are taking money out, that actually presents really good opportunities. So good valuations come about because there are sellers and people are scared. I think you have to bear in mind the environment is now very different from the last 10 years. So what has worked for quite a long time is not working today, and that's because interest rates are different. And indeed, if you look at some of the long-term trends in terms of supply chains, energy security, reshoring, a more uncertain geopolitical outlook, they are all inflationary. So I think the chances are that we stay at a higher cost of capital, and therefore you need to look to different things, different markets than what's worked for the last 10 years. And I would say that favours value, and particularly the UK market, which has been an overlooked market. And therefore from here, I think there's a really good both absolute opportunity to make money, but particularly a good relative opportunity compared to other asset classes investing in UK value.
Thank you, Alex. And so we have it. Our final speaker of the day, last but certainly not least, is an Investival favourite and someone who's never afraid of sparking a bit of controversy. I'm kind of hoping that he's going to mosey onto this here screen with a pea gun or at least a few custard pies. The Great Bank Robbery is the name of his session, and I'm expecting some fun and some thought-provoking questions about the modern banking story. Always a pleasure to welcome Managing Director and Chief Investment Officer, Kevin Duran.
Thanks for that, Danny. Picture the scene. It's 6 years since the nation redefined its relationship with Europe. And what's happened since is the leaders of that nation have become a laughingstock. They can't borrow money for love nor money. A group of immigrants are coming over the channel in boats, and a chancellor who's been in the job for just 45 days has a plan to save the day. Of course, I'm not talking about the current day, I'm talking about 1694. So it's 6 years on from the 1684 glorious revolution. King Billy arrives in Europe, forms an alliance with Queen Anne, and the two of those are going to now run the country. But they perpetuated that war with France. They basically bankrupted the country. And now they got to the stage where there's not enough gold out left in the vaults in order to continue with the war. Meanwhile, because of the wars between the Catholics and the Protestants within France, you've got a group of immigrants coming in, the Huguenots in this case, in boats, the largest migration ever to take place into England in proportional terms. And a new chancellor, a guy called Charles Montagu, who's got a plan, which he's borrowed from other people, but a plan nonetheless, to refinance the nation and borrow £1.2 million in order to refinance the Navy and get us back on the front foot when it comes to the war. Now, what is his plan? His plan is he wants to borrow £1.2 million, but the markets won't give him that money. They've been offered an interest rate of 8%, and even that's not enough. So Charles Montagu comes with some other ideas. One is to give the company a fancy name, the Bank of England, to give it a royal charter, to give it a little bit more pizzazz, and also, and here's the killer, to give them a monopoly right to print banknotes in the UK, lasting for 15 years. So from 1694 until 1710, the Bank of England has monopoly rights to issue banknotes in the United Kingdom. Now, with all of that in place, lots of people want to subscribe to this company. It literally is a license to print money. So what you've got on this slide here is you see the chap in the middle who's about to sign the share register. He's doing 17th century AML. So what he's doing there is he's swearing on the Bible that the money that he's about to subscribe is actually his. You've got a couple of key figures there. You've got Charles Montague in the nice resplendent white wig. You've got the first governor of the Bank of England, John Houblon, who's the guy also at the desk. And it's also, interestingly, being overseen by the Deputy Prime Minister of the day, a certain Dominic Raab, hidden away in the corner there. Now, for the next 100 years or so, the bank has an on and off relationship with gold. The notes are supposedly convertible back into gold, but of course, if the note is pari passu with gold, why would you go all of that trek back to the Bank of England to swap that piece of paper for a piece of gold, which is just the equivalent? But of course, as has always been the case in a fractional banking system, more and more notes are printed versus the value of gold that's actually in the vaults. This culminates in 1797 in William Pitt the Younger actually kind of putting the blockers on people being able to convert that money from notes into the gold coins. And this famous cartoon that you see on the screen here is where the name The Old Lady of Threadneedle Street actually comes from. So the cartoonist of the day pictured the Bank of England as an old lady and William Pitt the Younger trying to raid the pockets of the Bank of England. So that's where that name comes from. Now, that monopoly stayed in place post the period where you couldn't convert money back into gold. They kept that in place for over 20 years. But when they did come back, they decided it was time to lose the monopoly on the Bank of England to print their own money. And what they said is, this is not really fair, it's not competitive. Wouldn't it be nice if there were a whole bunch of other organisations who had license to print money out of thin air and create their own money, lend against that money, and create exchanges in that money itself? Now, that's a story that is prevalent in the 19th century as it is today, and it is effectively the modern cryptocurrency relationship. So, as was the case very recently, that was the case in the 19th century, and it ultimately culminates in 1866, a bank run on Overend and Gurney. Overend and Gurney was one of the large exchanges of those banknotes. And like I say, in a scene not dissimilar that we're seeing online right now, that's exactly what you're seeing in the FTX. It creates a crisis, creates a panic, and it requires regulators and smart people to get involved in order to come up with a solution. The solution in this case was to create something called a central bank, a concept that had not been heard of before. Walter Bagos, who ultimately goes on to become the editor at The Economist, comes up with an idea of what if there was a bank that in the event of crisis was willing to lend to other banks, a lender of last resort. That's where the idea of lender of last resort comes from, and it's also where the idea of central banks come along. And that's pretty much, until you get to the modern era, all you need to know about banks, particularly banks within the UK. But I've talked about at the start of this about how banks get stolen. Now, the greatest bank robbery ever pulled off in history was actually pulled off by this man. I'm sure you recognise him. It's Saddam Hussein. Believe it or not, at the start of Gulf War II, he sent a note. Now, I used to be sent round to the shop with a note from my mum to get a pint of milk and a loaf of bread. He sent his son round to the central bank asking for $1 billion, and he actually got it. So he sent his note and his son round to the central bank, and they loaded $965 million in greenbacks, untraceable banknotes, into 4 vans, and off they went. But is it the best bank robbery ever perpetrated? Because in 1946, coming back to the Bank of England, 1946, Clement Attlee comes into power and nationalises vast swathes of the UK industrial complex, including the Bank of England, creating the bank that pretty much you know to this day. So a monopoly on printing money, the bank that acts on behalf of the government, the bank that has the right to raise debt on behalf of the government, and is actually, from 1946, also owned by the government. Now, here's a question for you. Where were you on Black Wednesday? Black Wednesday, of course, was 1992. In the meantime, from the 1970s, we tried to control inflation, and the means by which we ultimately tried to control inflation was to outsource the problem. So when you peg your currency to someone else's currency, what you've effectively done is you've imported their monetary policy. So when the UK joined the exchange rate mechanism, we outsourced our monetary policy to the Germans. Now, in 1992, thanks to people like George Soros, that system was put under great pressure. Now, I remember where I was on Black Wednesday. It was a Wednesday in 1992. I just started A-level chemistry, and in walks a lab technician to announce to the class and to the teacher that interest rates have just been moved to 12%. We were messing around with some chemical experiments, but Mrs. Mason, my chemistry teacher, fainted. She hit the floor, and that was at the point where I realised that chemistry was nowhere near as interesting as economics was. That set off a chain reaction. So what happened post then is we had to bring monetary policy back on shore. We need to come up with a way of setting interest rates in the UK in order to control inflation. There were 3 countries who were messing around with the new experiment: Canada, Israel and New Zealand. And the new experiment was, what if you sent interest rates, rather than trying to control money supply or unemployment, which were things that are being targeted before, what if you just said what you were trying to do, setting interest rates in order to control inflation, otherwise known as inflation targeting. Now that ran for a number of years. Ken Clarke, who was the Chancellor of the day, and Eddie George, who ran the Bank of England, they used to get together, smoke a couple of cigars, have a couple of whiskies, and set interest rates in the United Kingdom. Such was the success of that experiment. By the time we get to 1998, and Gordon Brown and Tony Blair are now in charge, Gordon Brown formalises that process and actually puts the Bank of England formally in charge of setting monetary policy in the UK. So how do they do that? Bank of England Act 1998, they repeal some of the 1946 Act and then give the bank, through Section 11, the ability to set interest rates in order to control inflation in the UK. Now, how did they get on? So what you're seeing here is originally the inflation target was RPI. So for the first number of years, they looked at how inflation was on an RPI basis. And then from 2004, it's been done on a CPI basis. And you'll see for most of the 30 years or so since the bank has been given independence, for most of that time period, inflation has been pretty much under control. And it's only in the last 12 months that that inflation target has gone way above the recommended range, and the bank's now under pressure. So we're now back to these 9 people. These are the members of the Monetary Policy Committee. These are the 9 unelected bureaucrats who get to have major control over things that happen in the United Kingdom, just with the oversight of people from the Treasury. So we can take a register of the people who are on the MPC. It tells us who sits on the MPC in the minutes of the meeting. But everyone knows, of course, that there are only 9 members of the MPC. So what on earth is Claire Lombardelli doing in the meeting? Claire Lombardelli is the Treasury representative. She comes from Her Majesty's Treasury and she's been on the MPC since 2014. However, that position as a Treasury representative on the MPC has been there since March 2009. It was a condition for the bank to be able to do quantitative easing. So you might well ask, well, who did this role before Claire Lombardelli? That will be Sir Dave Ramsden. So there are now 2 of the 10 people, so 1/5 of the people who attend the MPC are actually Treasury insiders. And in politics is important. So we talk a lot about history, talk a lot about economics, but we also have to talk about politics if we're going to make predictions about the future. What you're seeing here is the number of mortgages in the UK, now 96%, which are on fixed rate terms. And what you're seeing on this line is the average fixed rate mortgage rate within the United Kingdom. That's as it was, and if I look at the numbers a couple of days ago on charcoal, for example, if refinancing your mortgage, you're going to go from an interest rate of around 2% to around 5.5%. Now, there are 11 million mortgages in the United Kingdom, 2/3 of which are people who are joint occupants, which means there are 19 million people in the United Kingdom who are impacted by what happens to mortgage rates. And that's political, because those 19 million people are potential voters. So let's go back to the Bank of England Act 1998. We talked about the powers of the MPC to set interest rates, but there's also reserve powers in that act. And the reserve powers allow, if it's in the national interest, the Bank of England can have their powers taken off them and the Treasury can set interest rates again. And that's the prediction that we're making today. We think there will be sufficient turmoil within the economy. It will be considered in the national interests. Desperate times call for desperate measures. They will temporarily suspend the independence of the Bank of England. And that will have significant impact, not only on bonds, but all risk asset classes that are out there. You may be familiar with a concept called Chekhov's gun. So the idea behind Chekhov's gun is it's a literary technique. You don't mention a gun anywhere in the text unless you intend to use the gun at some point. And I would argue that Section 19 of the Bank of England Act 1998 is the Chekhov's gun that will be used here. It's been mentioned, it already exists. You have a government with the means, the motive, and the techniques to take Bank of England's independence away. And it's something you should be aware of.
Thank you, Kevin. Well, that concludes the talks for today. And just a big thank you again for spending the morning with us. Now, just a gentle reminder not to close your session just yet, as the feedback form will automatically pop up. And we'd also be grateful of a minute of your time to complete our feedback and rate this webinar, the content, and, of course, our speakers. Your CPD certificate and a copy of the slides will be emailed out to you in the next couple of days, and we'll be sure to get back to you with any of the questions that you've submitted for our speakers. Now, enjoy the rest of your day, and until the next time, goodbye.